income, your expenses will lead to your profit or loss. That shows what you have done over a period of time. So we say it shows you performance over a period of time. And also, we also need to understand the movement in equity, which is given in the statement of changes in equity. In your statement of changes in equity, you have the flow of resources from owners of the company, how they have invested more, how they've taken out money from the company, what are the things that contributed to increase in their wealth, and so on. So one other statement is the statement of cash flows that shows movement of cash over time, right? So you have to be familiar with all these components. And in that same financial statement, we always have explanatory notes. The notes will come with accounting policy, which help you set the context for interpreting the financial statement. It tells you what management have considered, the policies adopted for each of the entities or each of the elements in the financial statement. So you understand that there are certain methods, policies, principles, bases that we adopt in preparing financial statements, and you should be able to get an insight into what they are or the ones that management have adopted during a particular period by going through the notes to the financial statement. So you have an understanding of the accounting method, the estimates made, the assumptions behind the estimates in that financial statement, right? So you could also see information about segments. That means if there are different components of the entity that contributes to the resources of the entity in terms of performance of position, you also have detailed information. Remember, the essence of providing this is for users to be able to make informed decisions. So you need to give them as much information as possible that is relevant to that decision making. And we have to ensure that it is also faithfully represented. Management will always have more information than other users of the financial statement, right? They are the preparer. They are primarily responsible for this financial statement. So sometimes it is good for you to see the financial statement through their lenses. So in their own words, they give you commentaries, they discuss and analyze beyond the numbers you are just looking at. So that could be another important source of information because it gives information about business trends, future capital needs, liquidity, and other significant events that may be necessary for that decision making, right? So these are not basic things you see in the in the basic information that I've provided in the FS, all right? So it is important to also see it through their lenses, and that helps you a lot. And because management is responsible for running the business and also preparing these financial statements, it is normally required for certain entities to audit their financial statements, especially public entities. So the audit is just another level of assurance, not an absolute assurance, really. It is a reasonable assurance to tell users of financial statements that the financial statement shows a true and fair view, but depending on the jurisdiction, that is what will determine the applicable financial reporting framework. And now the auditors will report their findings. So the work of the auditor is expected to be independent. They have to do an independent review of the financial statement to come up with their conclusion and give that opinion. So it will cover accounting policies adopted, assumptions, estimates, and everything that is relevant to that decision making. The opinion of the auditors could come in different form. If everything is all right, it will be clean. So we refer to that as unqualified opinion. And in also some other cases, you have a modified opinion in whatever form, depending on what leads to that. But it's highly important for you to know that at every point in time, management is responsible for the financial statement. And in addition to that, they're also responsible for maintaining an effective internal control system, which also means that they are responsible for the accuracy of the financial statement. And do not think at any point that the external auditor is responsible for that, right? The responsibility of ensuring there is no fraud, error, omission that are material is that of management. Auditors will provide assurance, but it's just a reasonable assurance to show that there's been an independent work on the financial statement. All right. Okay, so along with this financial statement, you also have other important sources of information, all right? The analyst could use in getting whatever they need to make their decision. So not necessarily the annual, it could be quarterly or semi-annual reports, proxy statements, press releases, earning guidance, so many sources of information that you could use in making that informed decision, and you could use in conjunction with the annual financial statement available. So, framework for financial analysis, basic steps, 6 steps. I believe you are familiar with this already. This is just to remind you if you've forgotten, right? So remember, you have to state the objective of your analysis. If you want to go through this process, you should have the end in mind. That informs the type of data you need. So you gather the data, then you go into processing. The objective should always drive the process, always have the end in mind. So analyze the information and interpret it. Report the conclusion or recommendation, then update the analysis as necessary. So remember these steps, right? So a quick one about financial reporting standard without wasting much of our time. Accounting standard guide the selection of accounting policy, right? Like I said earlier, depending on the jurisdiction, the applicable financial reporting framework, and that determines the standards that you use. In selecting accounting policies by management, you need to make reference to the applicable standard to ensure that the financial statements comply with this standard, which is also the basis of the auditor's report. So, we are expected to provide the useful information for users of financial statements. These reporting standards are designed in such a way that it helps you to achieve just that, all right? So that whatever you are presenting, will show the true and fair view of the position of the company and the performance of the company. Depending on the jurisdiction, the ISB is responsible for what we call the International Financial Reporting Standards. And we also have in the US, which is the FASB, right? You should be familiar with all these bodies. Remember, for example, in Nigeria, the ISB is not responsible for enforcing the applicable financial reporting framework. You always have regulatory bodies that determine what the applicable financial reporting framework should be, and they drive the enforcement process, ensure people comply, just like we do FRCN in Nigeria. So FRCN ensures that, IFRS, which is the applicable financial reporting framework in Nigeria, is duly adhered to. So security exchanges also, they do their parts. So all these regulatory agencies include the SEC, Financial Services Authority, all right? National regulatory authorities, supranational regulatory authorities, international organizations such as IOSCO. You have to know they enforce at different levels and ensure that people comply with these financial reporting standards applicable in that jurisdiction as relevant. Okay, so globally, effort has been geared towards achieving convergence. It will do a lot of good to users of financial statements if they could pick financial statement from the US that is prepared on the same basis as a financial statement from Ghana. Because what does it mean? It helps them to reduce the cost of analyzing financial statements. If they are prepared on different bases, they might need to do gap conversion before you start comparing financial results. But if they are prepared on the same basis, you just do the comparison without doing a gap conversion. So you have to adjust from US GAAP to IFRS to ensure they're on the same basis before your work starts. But you can avoid that if everybody prepares using just the same standard. Well, 100% convergence might not be achieved, but over time, differences have been removed from different jurisdictions. The most popular ones are actually US GAAP and the IFRS, and majority of countries are already adopting IFRS. The objective is, in the long run, maybe the whole world will move towards IFRS. So efforts are underway to ensure convergence. The effort is still ongoing. There are barriers to it, be it cultural, political pressure, whatsoever, that will, that has been hindering this convergence process. Okay, so you should also be familiar with the conceptual framework of for financial reporting of the ISB. It is not a standard, it is just a codification of the theoretical principles behind the standard. It helps to guide standard setting process, revision of standards. In cases there are no standards, users of financial statements or preparers can also refer to it to come up with accounting policy as necessary. So it's an important document. So it also tells you so many things. When you go through the document, what are the basic qualities of a good financial statement, the fundamental ones, the enhancing ones, and so on. So you need to familiarize yourself with that as well. So mentioned it earlier, your statement of financial position should be in your financials is one of the components, the statement of comprehensive income, the statement of cash flows, statement of changes in equity, and the notes to the financial statements. All right, so take notes. You have to be familiar with all these general features as well. Representation, going concern, accrual accounting, which is the basis of IFRS, all right? Consistency in the application of accounting policy when you have selected one. That doesn't mean you cannot change, but there are strict criteria for changing your accounting policy, which you'll see under IS 8. The essence of materiality when it comes to relevance of information, all right? Information will only be relevant if it is material. That means it is capable of, changing or influencing, affecting the decision of users, taken on the basis of that financial statement. You also need to understand that where aggregation comes in, and also areas where you cannot aggregate, right? Cases where you can offset assets and liabilities, cases where you cannot offset, frequency of reporting, be it annual, quarterly, half-yearly, and the standard that will apply in case you are doing reporting other than annual reporting, and the importance of comparative information, because that is the base of interpreting results, whether the result is good or bad, right? Without a comparative, you really can't tell what the major thing is, whether it's a good one or bad one. It's just like telling you, this year we made a profit of $1 billion. That information in isolation does not really mean anything. Because if you are saying, this $1 billion, it doesn't have the context. For you to conclude whether it's a good one or a bad one, you need to understand what happened the last year or years before that. So if the year before that it was 500 million profit, then it could be a good one. 100% increase. But imagine a situation whereby you are coming from 3 billion down to 1 billion. So that's the different case, right? So you need to understand the importance of comparatives for the purpose of analyzing financial statement and interpreting the result thereof. Okay, so the ISB and FASB, their framework are kind of similar and they are moving towards convergence. They've had joint projects whereby they've had to issue standards together. All right, so you need to also note that what they are doing, the efforts, and it is also important to know areas of differences in these standards for the purpose of this exam. So your questions will be majorly based on IFRS, but in some cases reference will be made to the US GAAP. So you need to understand the basic differences. For those that have gone through the curriculum, you will see the way it is done there. So you understand basic differences between the standards. So if they are the same thing, good. Areas where they are different, they are clearly noted to tell you under IFRS, this is how you treat this, under US, this is what is allowed, and so on. So you need to also be familiar with that. So a coherent financial reporting framework should exhibit transparency, comprehensiveness, and consistency. And framework also sometimes are revised because the essence of it is that there should not be a conflict between the framework and accounting standards, since it is the basis of those standards. But we've noticed that in practice, in reality, conflict exists sometimes. So the framework themselves are not sometimes perfect. So The standard setting body could go back to the drawing board and say, okay, we need to adjust this and that, right? As recently done to the conceptual framework of the IS. So what are the barriers to coherent framework? Most times it will have to do something with measurement. Measurement could be a problem. The process of standard setting, right? Issues of valuation and so on. As analysts using financial information, you have to be aware of new standards, including those that have not been effective. So you need to be familiar with new standards that are effective, standards that are not effective, but have been issued. Exposure draft that could lead to standard in future, improvement projects. You need to understand discussion papers, all these things help you to, provide further insight to the information you have right now. Because if you know this is the direction in future, and that future is near, or is even already effective, then you can tell what is to be different from now, right? And also how the new standards have been applied. It is very, very important. Sometimes they are full retrospective, sometimes they are modified. So if you don't understand the application guidance, sometimes you might not be able to interpret it correctly. It is important for you to be aware of that as well. Companies will always disclose their accounting policy, all right? It's very important. Estimates made in the financial statement, right? They will also do that. It is important for you to be able to go into this information and let it guide whatever you are doing. You don't just compare without having a proper understanding of the accounting policies, the estimates made, the assumptions, and so on. So they help you in comparing. Okay, moving on straight to income statement. Income statement is straightforward. The two elements you want to see there, I want to believe you still recollect that we have 5. We've mentioned them already this morning, which are your assets, liability, equity, income, then your expenses. So the focus of the income statement is to bring your income and expenses together, right? So your income is made up of your revenue and other gains. That's gains. We refer to them as gains. The conceptual firm, we also call them other income, right? Other income. Then your expenses coming from different sources, they make up everything that will be in your statement of comprehensive income. So what goes into profit or loss, you should know the difference from what goes through other comprehensive income, right? Even in other comprehensive income, you should be able to tell the difference between those that will be recycled. That means reclassification adjustments that will go into profit or loss subsequently, and those that will never be reclassified. You should also understand the presentation of the income statement, right? It's very important. You could have a multi-step income statement, right? Gross profit will be shown and different level of profit. You could also have a single-step income statement that does not show it straight to your final figure. The presentation of expense could also be by nature. It could also be by function. I should also note the disclosure requirement that comes with it. If you do disclosure that's presentation by function, you also need to do additional presentation by nature, which is yes, right? So that your users of financial statement can have an insight into the nature of the expenses recognized. So revenue reporting standards, that's IFRS 15. Be familiar with that standard as well. And what are the basic things in IFRS 15 that guides revenue recognition? There are 5 steps. So IFRS 15 uses a 5-step revenue recognition model. Identify the contract with customer. You identify the performance obligation. You determine the transaction price, right? Then allocation of the transaction price is done to all the performance obligations identified in case it is more than one, right? Then the last stage, which is the most important one, you recognize revenue when performance obligation is satisfied. Well, other steps are also very important, but the one that leads to recognition in the books, which is step number 5, you need to ensure that performance obligations have been satisfied before you do that, which could be over time, if it is a performance obligation satisfied over time, or it is at a point in time for those that are just passing straight to the customer once, right? So you need to understand depreciation in relation to long-lived assets. That is your non-current assets, how depreciation is calculated. Also, maybe an insight to how these assets are tested for impairment, what are the impairment requirements, how often do you do this impairment. Okay, so you should also be familiar with inventories, which you are still going to look at separately. So we'll move on to that. We won't waste much time on it. We are still going to look at it as a topic. So understand inventories, all the elements of this financial statement, you should have a good understanding of them. So you would have non-current assets that are made up of things like property, plant, and equipment, all right? Also intangible assets, and maybe long-term investments, and so on. Then you should also know current assets, which are majorly your receivables, inventory, cash, and other assets that will be realized within the operating cycle or within a period of 6 or 12 months, whichever is shorter. All right. So users of financial statements will always want to analyze this thing. Remember that you need to give them an insight into how the performance of the entity will be in future. That means you should be able to tell them what is continuing operation and distinguish it from those ones that are discontinued, so that when they are doing their projection, they don't continue to incorporate the discontinued operation, right? If you make money from an activity that will continue to exist in future, you need to show it under continuing operation, then segregate that from those that are from activities. Here, you made money, but because those activities will no longer exist in future, you need to show them separately so that users of financial statements will understand how to deal with them when they are making forecasts, right? So far it is non-recurring, they should understand that so that they don't continue to incorporate it into whatever model they are using. So understand the impact of changes in accounting standard. I mentioned it earlier, IS 8, when accounting standards change, how are they applied? Cases where management can also change the accounting policies is also very, very normal. All right. So on the income statement, you also have a presentation of basic earnings per share and diluted earnings per share, right? So your earnings per share, how is it calculated? You should remember that it is basically the profit attributable to owners of equity of the company, ordinary shares especially. So what is the profit attributable to ordinary shareholders? If you're able to bring out the profit attributable to ordinary shareholders, you have the numerator. That's why you have net income less dividend on preference shares, right? Because we are concerned about the ordinary shareholders of the company. So what's the profit attributable to them? And what is the weighted average number of ordinary shares outstanding during the period? It gives you the basic earnings per share. Then, in addition to that, you should also understand what we mean by diluted earnings per share. So just a minute, my screen will come back up. I notice that you cannot see it anymore. So it's coming back up. So there are some times that company will issue potential ordinary shares, right? We need to know the impact of these potential ordinary shares on the earnings of the company in future. So just give me a minute. The slide will be back up. Apologies for that.
Just a second, please.
Thank you.
Imeji, you can go on.
Frank, you need to allow Dimitri.
You're a co-host already, you can share.
Okay. I believe we are back up. Apologies for that, please. I was at earnings per share. I was talking about potential ordinary shares. That means items that are currently not ordinary shares, but they have the potential to become ordinary shares in future, e.g. Convertible debts, convertible preference shares, options, warrants, all those instruments are currently not ordinary shares, but they have the potential to become one in future, all right? So right now they are not, but because they're already an integral part of the entity's activity, you need to know if they become ordinary shares in future, what will be the impact on earnings? If it has the potential to water down the earnings of the company, earnings per share, in terms of the return per unit of share held, we say it is dilutive. So we need to consider the impact. So we have convertible preferred dividend, convertible debt, interest adjusted for the tax impact, because interest on debt instruments are tax deductible. So we factor that in to get the reduced earning. Then we divide it by the weighted average number of shares. When we get to question and answer, we'll solve a question on this. So you see how it is being done. In case you've forgotten, I want to believe you've read it already. So shares from the conversion of preference shares, shares from the conversion of debts, and also some items that will not have an impact on earnings, but they will have an impact on the shares, such as options, all right? So bring them all together, then get what the watered down earnings per share is going to be. So that's what we call the diluted earnings per share. They have the potentials to become ordinary shares in future, thereby reducing the earnings per unit of share. So for the purpose of understanding financial statements of a company, in case you want to compare with that of another entity with a different size, you can bring everything to common size so that you can see in terms of percentages of revenue of each item in that income statement. It helps you to get insight into trend. You can use it for discerning patterns over a period of time. You can also use it for comparative analysis, right, with peer companies. So all these things are important to your understanding of what is going on in their financial statements, right? It helps you to understand the business strategy. And you can easily read some important ratios from the face of a common size financial statement once you have one, e.g., gross profit margin, the net profit margin. At the end of the day, you can see what percentage of the money made that the company is going to retain in the business. The other comprehensive income, that's where you see items such as gains and losses on translation of the financial statement of a foreign subsidiary, remeasurement gain or loss on your retirement benefit obligation, unrealized gain or loss on cash flow hedging of derivatives, then unrealized gain or losses on your financial assets that are held at other comprehensive income, that's fair value through CI. Okay, moving quickly into balance sheet. I will have to, just run through everything so that we have sufficient time to solve questions, like I said. During the question and answer, you have further insight into many of these items. The balance sheet, which is your statement of financial position, gives you a snapshot of the resources controlled by an entity at a point in time. It is as at a point in time. If you compare statement of financial position at the end of a day to the end of the following day, it is unlikely to be the same thing, right? If cutoff is properly observed. So it shows the asset control and also the distribution of these assets, which is between liabilities and equity. And that is the base of the accounting equation that says assets will always be equal to liability plus equity. Whatever does not belong to parties you are obligated to definitely belongs to the owners of the company. So equity is seen as a residual. So your asset is expected to generate future economic benefits to the entity. That is why it is an asset, right? And you have to have control for you to be able to recognize it in your books. You can then, on the basis of the statement of financial position, assess liquidity, which shows the ability of the entity to meet its obligation in the short term, the solvency of the entity, which shows the ability to meet obligation in the long, right? And also be able to distribute anything to shareholders, right? It is important. A company can be profitable but unable to pay dividends. So you should be able to get detailed information from the financial statement. So that is why the financial statement has to be faithfully represented. All right. So in terms of presentation, current, non-current distinction will always be there. For those that use that method, you can also present it in order of liquidity, which is allowed. All right. So you see all the elements there, and all the standards you've read through this course will form the base of the elements recognized. So which we've already mentioned earlier. Your statement of cash flows, which is the next one, provides further insights, which is different from what you are seeing from other financial. This is a different financial statement. Remember that we said the base of this financial reporting is going to be accrual based, right? But this is one component of the financial statement that does not respect the accrual concept, right? What you do is to show movement of cash of the entity from the beginning to the end. So what contributed to increase in cash? What are the things that reduce your cash? And you should be able to categorize them into those relating to the principal activity of the entity, which we refer to as operating activities, the investing activities, and also the financing activities. It is important to be able to do that, right? And you should also know some items that you can present in more than one places under US GAAP, under IFRS. So in US GAAP, dividend will be a financing cash flow, right? Interest paid, interest received, dividend received are operating cash flows. All taxes are operating cash flows. But you understand that under IFRS, it's a little bit different. You need to understand that. You can decide to report your interest received and dividend received under either of these two, which is your operating or investing activity. What we just emphasize is consistency. If you do something in a particular way, then you have to continue to do it that way. And if you want to change, it's going to amount to a change in accounting policy, which is a major reclass. So you let users know what has changed and how they should interpret it going forward. All right. Now, taxes will also normally be operating cash flows, except you're able to relate them to items of investing or financing activity. You should also understand that there are two methods of presenting this statement of cash flows. You have the direct method and you have the indirect method. The difference will be coming majorly from the operating activities. The investing activity and the financing activity will still remain the same. The indirect method seems a bit simpler because it uses a figure in the income statement and you reconcile that to the cash. So using information that is already contained elsewhere in the financial statement, while the direct method is going to give you further insights because it shows the presentation in such a way that you won't be able to get that information elsewhere in the financial statement. So please take note of that. You have done free cash flow from other parts of the paper. So the understanding is still the same. I will not want to spend much time on that. You can leverage on your corporate finance and equity. Then financial analysis technique now, quickly. Ratios are very important when it comes to analysis of financial statements. Ratios are very, very important. Ratio is not the only way to interpret FS, right? But they are also very, very, very important. Now, you should be very familiar with ratios. If you are taking this paper, I believe you've done that. You can combine ratios to derive other ratios. You know what they mean. You can interpret them easily and move on to something better. Okay. Common size data, which we have mentioned earlier, is also very, very important. So you need to understand how to use it. Then you should be familiar with the limitations of ratio. Definitely, you can influence ratio depending on the selection of accounting policy. This is very, very important because when you compare one entity to the other, you have to ensure they are on the same basis. So understand that limitation. Understand also that it is majorly based on historical information, so it does not necessarily provide an insight into what is happening in future. And you should be able to make adjustments as necessary. So comparable ratios may be hard to find for companies that operate in multiple industries. When you look at two entities, they seem similar on the outside, but sometimes when you drill down, you discover that maybe one has a line of business that is totally different from the line of business of the other one. You need to be able to adjust for that before you're able to compare them meaningfully. So it's a difficult job and it's not something that should be underestimated. There should be a concept or a context rather. Ratio must be analyzed relative to one another. I think I've mentioned this earlier. So we don't need to repeat that. We can move on to something else. I want to believe we're all familiar with this already. How to combine ratios to achieve one ratio. If I ask you to calculate return on equity, you should be able to move from your profit margin, to your asset turnover, then to your leverage multiplier. It is important for you to be able to combine them to achieve another ratio, because sometimes you have a question that does not give you the details, but just provides ratios to you to derive other ratios. You should be able to do that, and also be able to break down the margin, right? Break it down further. So all this you should be familiar with. We are going to take 1 or 2 questions on them. And also understand categories of ratio. There are some ratios that are used to analyze profitability. What are they? How do you use them? How do you calculate? How do you interpret them? There are some that focus on liquidity. There are some that focus on solvency. There are even some that are used for just investment. So investment ratios, you see them a lot. Price cash flow, price to sales, price to book, basic and diluted earnings per share, and so on. For credit analysis, you think of things like coverage ratio, return on capital, which is actually a profitability ratio, is important for credit analysis as well. Interest coverage ratio, right? Think of debt to asset ratio, which is a solvency ratio. So you should understand the categories and how you can combine them. So understanding of the segment is also important, which I mentioned earlier. So I have an insight into that as well. Ratio analysis is an important tool. If you use it very well in conjunction with other techniques, then you are going to get something that is very useful out of the financial statement. So the role cannot be overemphasized, but at the same time, use it with caution, be familiar with the limitation. It is very, very important. So learn how to calculate, learn how to interpret, then know the limitations. So we'll just talk quickly about inventories. Inventories, no matter how big they are basically items that you have acquired for resale in the ordinary course of business. And you should know that initial recognition of them is at cost. And that cost will include all the money you've spent, that is cash and cash equivalent, plus other assets you've given up to acquire them, that are necessarily incurred, all right? Which will include purchase costs, conversion costs, and other necessary costs you incur to bring it to the present location and condition. Abnormal waste, storage costs, administrative costs, and so on are not included. So you should also understand the cost formula that are allowed. For cost flow methods, we are saying first in, first out is allowed. Take note in terms of recognition of the cost of what you've sold. Whatever comes in goes out first. Even if in terms of physical dispatch, that's not what you do. But for the purpose of getting proper accounting, you make that assumption, and this assumption is allowed. So the cost flow assumption here is that whatever item you purchase first is sold first. Last in, first out is allowed under US GAAP. Please, it is never allowed under IFRS. Weighted average cost is also allowed. Then specific identification. So those 4 cost flow assumptions, be familiar with them, but it is important for you to know that we don't use this in IFRS. It is totally prohibited. So whatever goes in first, goes out first under first in, first out. Whatever comes in last, goes out first, under last in, first out. Then weighted average, use the quantity as the weight, then you get an average over time. And also depending on the inventory system that the entity keeps. Is it a perpetual one, right? Is it a periodic one? It also affects. You should be able to know the impact of all this. I would have loved to take you everything in depth one by one. Unfortunately, we can't achieve that in 2 hours, and I'm glad you've read already. So this is just the confirmation of all the things you've read, and also to remind you of key areas you should pay attention to. Okay. So it is important for you to know the implication of the cost flow assumption that the entity is using. If you are using last in, first out, it will result in higher cost of goods sold. This will be helpful to you when you are trying to compare the financial statement of 2 entities One prepares, say, under US GAAP, while the other prepares under IFRS. If the US GAAP entity presents using last in, first out, while the accounting policy of the IFRS entity uses first in, first out, you should understand that last in, first out will result in higher cost of goods sold. But please, the assumption is that prices are increasing and inventory quantities are either stable or increasing. So if prices are increasing, which is the normal expectation, the normal expectation is that, well, the inflation should not be too much, but price will continue to increase a little bit over time, right? So if that holds, then cost of goods sold will be higher under last in, first out. Gross profit will be lower as an implication of that. Inventory balances will be held at an artificially low amount of money. Then inventory turnover will be higher. Then you should understand that reverse is the case if we change the assumption, assuming price is decreasing. So reverse is going to be the case, which is exactly what we have depicted here. So when it is decreasing, you should understand that it is going to be the reverse. All right. Weighted average will always be in between. Always be in between, right? So it is also important to note that. So when you want to interpret what is going to be the implication of weighted average, you can look at the impact of last in, first out and first in, first out. Somewhere in between, the weighted average is going to be there. Okay, so in terms of valuation, under IFRS, inventories will be valued at lower of cost or net realizable value, right? Mostly it applies to under US GAAP, but we are going to see the difference. If you write down inventory to net realizable value, in subsequent period, this could reverse. That's why we say write-ups are allowed under IFRS, but only to the extent of the previous write-down that you had recorded. So, like I mentioned earlier, it applies mostly under US GAAP also. Inventories are normally valued at lower of cost or net realizable value. For companies that are using method other than the last in, first out or the retail method. So if a company uses the last in, first out, inventory will be valued at lower of cost or market. And you need to know the implication of this. It is not the same thing as lower of cost and net realizable value. So when we say market, so that market is usually equivalent to what will be the replacement cost of this particular item. But there is also a limit. There's an upper limit, there is a lower limit. So we are saying, when we say measure it at lower of cost of market, you have the cost, then you are trying to get the replacement cost. But there is a caveat that the replacement cost you are looking at cannot exceed the net realizable value. And at the same time, it cannot be less than net realizable value minus normal profit margin. If you have forgotten this, or maybe you skipped it while reading, you need to pay attention to it. So, and meanwhile, no subsequent write-up is allowed. Also note the impact. When you write down inventory, what's going to be the implication? There's going to be decrease in inventory, decrease in asset, decrease in equity. These are simple things that can get you marks in the exam, right? Increase in asset turnover, debt to equity ratio, and debt to asset ratio. All those ones will increase. So take note. So if there is a write down, decrease in all these items that we have here, meanwhile, it will increase in turnover, debt to equity ratio, debt to asset ratio. The best way to do this sometimes is, if you cannot remember, try not to memorize. Be able to play around with figures. So just come up with assumed figures. Then if you do this adjustment, what's going to be the impact? So it tells you the answer easily. So instead of just memorizing, then getting it wrong when you are confused or under pressure. Okay, so remember the write down is going to be a loss in your statement of profit or loss. And there are certain disclosure requirements also. All this information taken together will help analysts to get something meaningful and be able to interpret. And we also use it to determine the efficiency of the entity, all right? In terms of how long it holds inventory, what's the inventory turnover, which can also calculate in days, right? All these things are very, very, very important. Non-current assets, what you should be familiar with, all right? The different standards that relate to non-current assets in terms of property, plant, and equipment, investment property, borrowing costs, government grants, intangible assets, that's IS 38. You should be familiar with them and be able to apply those standards. If you're able to get all the misconceptions in the standard also, it helps you because they are sometimes the focus of an exam question. So all these things are expected to bring economic benefit. That's why we call them what? We call them assets. For intangible assets, you don't just amortize them. You always check whether they have finite useful life before you do that. You know, the base of depreciation is useful life. If it has a useful life, then you should depreciate over the useful life. That is the general understanding. So for intangible asset, the first step we do is check whether that asset has a finite useful life or an indefinite useful life. So if it has a finite useful life, then you amortize over those periods. In case the conclusion is that it is indefinite, then you don't amortize because there's actually no useful life. Rather, you test for impairment annually. And in addition to that, you continually check whether there's still evidence to support your position that the useful life is indefinite. So also note the accounting treatment of research and development. So under IFRS, research costs are expensed. Take note of that. So far certain criteria are met, it is not just a pass that you must capitalize development cost. Certain strict criteria must be met in terms of being technically feasible, resource availability, probability of generating economic benefits, and being able to estimate the amount reliably. So once you're able to meet those strict criteria, then you can capitalize development cost under IFRS. Under US GAAP, both research and development costs are incurred, right? If you create software, yes, you're allowed to. So specific cases, there's a little bit of difference between the two standards. When you acquire a business, acquisition method is used, and that is the base of calculating your purchase goodwill. It is simply comparing what you have paid in terms of consideration to the fair value of identifiable assets acquired. So once you do that, you get the goodwill, and goodwill will not be amortized. It is going to be tested for impairment, the way we discussed non-current assets, that's intangible assets that have indefinite useful life. So understand depreciation. Remember, the reason why we depreciate assets is because you are going to consume them over time. Understand that. And you know the reason why assets will not be depreciated. If I ask you, why don't we depreciate land? I don't want to get response like, oh, because it appreciates in value. Definitely not. The reason we don't depreciate, if you see any case like that, will be because the useful life cannot be estimated reliably, which is the same thing that applies to intangible assets with indefinite useful life. So don't give a response that, oh, because it is an asset that appreciates. Many assets appreciate in value, but we still depreciate them because they have a useful life, limited useful life. So that is why you use revaluation method. You revalue upward, but you still what? You still depreciate. So know how to apply depreciation method. Know that your depreciation method should be reviewed annually. You don't just choose a depreciation method and just leave it, right? So your depreciation method, you're supposed to be reviewing it every year to check if there is a need to change, then you change. And that's not the only thing you review every year. You review your depreciation method, you review residual value, then you also review useful life. So those things are not constant. And if you don't do the annual review or you don't do it properly, then that means you're not applying the standard very well. So know the different method. Under IFRS, component depreciation is a requirement. meaning that if you have a complex asset, that has different parts, and each of the different parts are material, and they have different useful life. So just think of maybe you have a vessel, you have an aircraft, and they have components like the engine, the interior, the frame. All those things don't last the same number of years. So that is an example of a complex asset that you depreciate in components, all right? The interior will go over its own useful life, the engine over its own useful life, the frame over its own useful life, and that. So understand those bits. And in this review, you should know that at any point in time where your residual value, remember I said you should review 3 things. If you could remember the 3 things I mentioned, that you review them every year: the depreciation method, residual value, then useful life, right? Those 3 things are to be reviewed annually. And if there is a change in them, it is treated as a change in accounting estimates. So that means you don't go back to previous years, you just focus on future years and do the right thing. Depreciate accordingly based on the new useful life, based on the new method, using the new residual value. If you find yourself in a situation that residual value is more than carrying amount of the asset, you suspend depreciation for a period of time. So those basic things, if you're able to pick them, it is very, very important. Also know the impact of this depreciation amortization on your cash flows and so on. Revaluation method or model, revaluation model is an option under IFRS for the purpose of subsequent measurement of your either intangible assets or property, plant, and equipment. You are allowed to use revaluation model under IFRS. US GAAP does not allow the use of revaluation. It is important for you to remember that. So we only use revaluation model under IFRS, and it applies to both PPE and intangibles. And you also should know that for intangibles, there is a caveat that you can only use your revaluation model if an active market exists for that intangibles. It is not a requirement for PPE. So requirement for PPE, so far you are able to determine the fair value, you can go ahead. But for intangibles, an active market must exist, right? So you should also know how this revaluation is treated if it is applied under IFRS. Gains will normally go to other comprehensive income for the first time, except where it is reversing a previous loss. That is when you take it to the statement of profit or loss. As to the extent of any loss, it is reversing. So the same thing applies. If you have a loss initially, it goes to the income statement as in profit or loss. And subsequently, when you have one that is reversing a gain, then you take it to OCI to the extent of any gain in there. So also understand impairment requirements and the difference between impairment requirement of IFRS and US GAAP. In summary, under IFRS, the asset is impaired if carrying amount exceeds recoverable amount. And when we say recoverable amount, it is simply higher of fair value less selling costs, right, and value in use. So if you look at the fair value and the cost of disposal of the asset, on one hand, compared to the value in use, that is what you will derive from continuing use of the assets, discount to present value. Compare it, whichever is greater, that's the recoverable amount. So if carrying amount happens to be higher than the recoverable amount, the asset is said to be impaired, then you write it down to the recoverable amount. Take note, if the asset happens to be impaired, you write it down to the recoverable amount. And this impairment can reverse subsequently, all right? To the extent of any loss you've recognized, you can always reverse your impairment under IFRS. That's what we refer to as loss recoveries. So any impairment could reverse subsequently. So far, there is evidence that what led to that impairment in the first place has now subsequently reversed, right? Very important. Under US GAAP, note the difference. The asset is impaired when the carrying amount is greater than the asset's undiscounted future cash flows. They are 2 different things. Recoverable amount uses greater of fair value less the cost of disposal and value in use. Meanwhile, for the test of impairment under US GAAP, you are looking at the cash flows that will be generated undiscounted. You are comparing it to carrying amount. So if the asset is impaired, you will now write it down to fair value. Please take note of that. Write it down to fair value. And subsequent recoveries are not allowed. Subsequent recoveries are not allowed for assets held for use. So just note those simple differences. They help you. All right. So know the time to derecognize them, and when you derecognize them, how it is treated. If no future economic benefit is expected, what you do. An impact of all this treatment, depreciation, what financial statement component they affect, does it have an impact on cash flow? What ratios will they affect? If you charge impairment, what are the impact on ratios in terms of your net income? All right, you should know that it is going to decrease. Is a reduction in your asset, and eventually it will lead to a reduction in your equity. And the impact on the ratios such as return on assets, return on equity, and so on, will be affected. So note those impacts. It is very, very important. So different disclosure requirements. Disclosure is important. Nobody will ask you to regurgitate disclosure requirements in the exam, but it's important for you to know that all this information are there in the financial statement. You should understand the level of info you can get in the financial statement. So we have a standard code IS 40 in IFRS that talks about investment property. And this property we are looking at, remember, it's a property. Investment property looks solely at property, land or building, part of a building, both land and building, that you are holding either to generate rentals or for capital appreciation, or both. So you are holding it to generate rentals, holding it to generate capital appreciation, or both. So the allowed alternatives under IS 40, you have the cost model and the fair value model. Fair value model is not the same thing as depreciation. Note the difference. For fair value model, you don't depreciate the asset, and the fair value is done every year. Whether gain or loss goes into P&L. Meanwhile, for evaluation, you don't necessarily do it every year. Remember that the asset is still being depreciated. If you have a gain, it goes to OCI, except it is reversing a previous loss. If you have a loss, it goes to the income statement. So remember to pick out those differences. Very, very important. Also familiarize yourself with IFRS 16, accounting for leases, right? How you account for leases. From the point of view of the lessee, there's just one thing that happens. There is a lease. And basically, what happens is that the lessee recognizes the right of use asset and also recognize the liability for the lease. So it is recorded in the lessee's statement of financial position as right of use asset, which is basically its interest in that asset. So this distinction of finance lease, operating lease is majorly from the point of view of the lessor. So be familiar with the new requirement under IFRS 16. Okay, so familiarize yourself with income taxes as well. Current tax as opposed to deferred tax. What are the differences? Deferred tax is a pure accounting problem. It is not based on tax law. It's an accounting requirement. How do you calculate it? It is very simple. It is basically your temporary difference multiplied by tax rate. What is temporary difference? At what point do you recognize in case you have an asset? To what extent do you recognize the deferred tax asset? What are the things you consider? All those things are very, very important. So familiarize yourself with it. Take time. Then also familiarize yourself with non-current liabilities. Very, very important as well. Financial instrument standards will play an important part here. So how do you treat your liabilities? Basically, most times they'll be treated as amortized costs, and you should also consider that fair value recognition is also allowed. If they are amortized costs, they use the effective interest rate method of recognition. So at the end of the day, it goes back to the face value, all right? Also understand the impact of debt covenant and restrictions on borrower, and how it will affect financial statements, and how these things are separately disclosed, and the details you have to provide on your liabilities in the statement or in the notes to the financial statement. You need to understand that. Okay, so we've talked about lease accounting also. Know the impact of the liability leg. Now it affects financial statements and all. And your ratios in relation to solvency. If you have all these long-term debts, know the ratios that apply. Ratio analysis is key. I've mentioned that earlier. So we talk about financial reporting quality. So financial reporting quality refers to the basic characteristics of a firm's financial statement. We mentioned that in the conceptual framework, the fundamental characteristics of a financial statement, a good one, is that it should be faithfully represented. Faithfully represented. If that is not the case, there is a problem. So you need to be aware of that. So when you are looking at high quality financial statements, what are the things you are expecting? It should adhere to generally accepted accounting principles. In addition to that, it's not just mere compliance. You have to apply the spirit also. So it should provide information that will be useful to users of financial statements. So I would say it is decision useful. That means it has to be both relevant to decision making, and it has to be what? Faithfully represented. It purports what it should. It is free from bias, influence. You have to be objective in presenting it. You're not concerned about how it will, the mood of those people that need it. Let it present what it should present. They should interpret it whichever way. Don't make decisions for them, and because of that, modify the information. All right. So quality of reported results, basically focuses on the level and sustainability of the firm's earnings. There is tendency for companies to want to, report good performance. There is that pressure sometimes. There could also be motivation for it. Think of situations where their bonuses are linked to this earnings. So the higher the earnings, the more the bonus they get. So there could be so many pressure or motivation for trying to influence earnings. So whatever earnings they are showing to us, we want to think of, is it sustainable, right? What about the cash flow? Is the cash flow healthy enough to support the solvency and liquidity of the entity? And you also want to look at the resources held by the entity at every point in time. What makes up the asset? Are they high quality? If there is a problem, are they things that can actually be realized? So if you have high quality earnings, it is simple, right? They'll provide the owners of the company with adequate returns, and they are suitable to the future. So you should also understand the spectrum of this financial reporting quality. It is very, very important. What is the highest and what is the lowest? So you think of the highest, that the financial statement is compliant with the applicable financial reporting framework. Very, very important. And it is decision useful. That's what we really need, because the essence of that financial statement is to provide this useful information. That is, earnings are sustainable and they are adequate. That is the highest level. That is what you want to achieve. So another level is that this reporting is compliant. Yes, it is decision useful, but the earning quality is questionable, right? They've done everything. They've provided information. maybe they've used an accounting policy that will, increase them, even though it is allowed, but you know that it is not sustainable. It is not sustainable. Maybe they use that policy just to be able to achieve that particular purpose. So yes, it's compliant. We can use it for decision making, but the earnings are not sustainable. So we say the earning quality is low. That is still fair to some extent compared to those ones that are not compliant. So that means they've deviated from a requirement, an important requirement, and something material has been, if you don't comply with the reporting standard for a material item, then there's a problem. So when you say reporting is not compliant, we are talking about the impact on material items. Remember, transactions and events are only according strict accounting treatment when they are material, right? So if it is not material, it is not a problem. So when we say reporting is not compliant, there's been a material misstatement in that financial statement. Any quality is low. Reporting choice and estimate are also what? Biased. So the quality is very low. It gets worse, right? Because you have level where it is not compliant and earnings are actively managed. Maybe they use accruals and provisions to show whatever they want you to see, right? They actively manage it. They just want you to see something. At another level, you think of reporting that are not compliant. Numbers that are presented are based on companies' actual economic activities. And another spectrum, it is not compliant, and they have even included things that are fictitious and fraudulent. So you should understand the impact of all this and the impact of maybe what is going to be the impact of audit opinion, how does it come into play, what is the auditor expected to pick, what it will not pick, right? So nowhere in the financial statement to get accounting policies, information about estimates, assumptions made, so on. It helps you in making informed decision. And you should be able to apply this in getting information about trends, financial ratios, and so on from the financial statement of an entity. Get as much information as possible, know the impact of all the type of accounting policies they've used, how you can make adjustments to do that conversion if you want to compare two entities that are preparing under two different bases. All these things are very, very important. So we'll take the remaining time to solve questions. And I believe on your own, you still go back to do one or two things, right? So read more before your exam. It helps. The more questions you practice, the better it is. You go into the exam all as if you are doing a revision because you've read, you're adequately prepared. So the approach we are going to use, I'll give you max of 2 minutes to solve the question. You drop your response in the chat box. Please do that for me. So once I open the question, your time starts. Then you go into the chat box, drop your answer, then we solve it together. All right? Mm-hmm. So your time starts now. Just drop your answer in the chat box, and that'll be it. Okay, you're getting responses. C, okay, C. That was, I can see we have over 70 people in class. I'm expecting more responses. The question says, which phase in the financial statement analysis framework is most likely to involve producing updated reports and recommendation? Okay, so I see other people saying A now. It seems we have two schools of thought. We have those that believe that it's a C when you develop and communicate conclusion, And a lot of people are saying it too. So who is correct? Which group is correct? Okay, so yeah, we've gotten a lot of responses. Thank you for doing this. The correct answer is actually A. Please note, it is at the follow-up phase that you gather more information, try to repeat the analysis, and update your report where necessary and do the necessary adjustment. So updating reports will come at the follow-up phase, not at the development or communication of results. Please take note of that. It seems simple, but if you get it wrong, you miss all the marks, all right? Good. Next question. Drop your answer. Time starts now. So going through the chat box, we already got a question on this, and I'll use time to address that, but just look through, drop your answer. I can see a lot of C. I think okay. I saw it also. A, C, C. Okay, I've seen B also. C, C, D. So you see exam. That is why all of us at the end of the exam, we're always happy. Oh, yeah, my answer, I got everything. I was able to finish. So most times it is not how far, it is actually how well. So you need to check that you have done the right thing. And the only way you can do that check yourself is if you have practiced a lot of questions. So you practice this once, practice it twice. Don't worry, you never forget it again. So this addresses one of the earlier questions. Please take note. The question says, which of the following statements best describes the role of the International Organization of Securities Commission? So take note, it is not a regulator, all right? But its role is to assist in attaining uniform regulation. It assists in doing that, right? It is not a regulator on its own, but it assists in attaining the goal of uniform regulation. And basically, uniform regulation, cross-border cooperation, and enforcement of these international financial standards, right? We also focus on how to combat, violation of securities law and all. So the correct answer is going to be C. It assists in attaining the goal of cross-border cooperation in combating violations of security laws. All right, which of the following best describes the role of IOSCO? The correct answer is C. Is the oversight body to the ISB. That is definitely not correct. Is responsible for regulating financial markets of member nations. It assists in attaining that objective, but each local regulator is still responsible for their markets. So you need to be aware of that. Okay, so I'm sure we have some people that have scored 100 already. That is the expectation. And if you have not scored anything right, don't be bothered. You should just know that you should go back into what you are doing for the last minute phase, right? Read more, not passively, but actively. And I say active reading, what do you do? Instead of just taking the question and try to go over it and compare answer by just reading the answers, you try to solve on your own, solve actively. Don't look at the answers, write it down. Don't just solve it in your mind. So number 2, the correct answer is C. C, assist in attaining the goal of cross-border cooperation in combating violations of security laws. The correct answer is C. Okay, the next one. A, B. Okay. I've seen A, I've seen B, A, B, A, B, A, 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 B, A, B. Okay. B. Good. So which of the following reports is least likely to be filed with the US SEC? So for all these things that we are doing, please just adopt a particular approach. For those that are reading, different people with different methods, some people are reading the curriculum, some people are reading summaries, whichever you are doing, ensure you optimize it, right? But some of this information can be confirmed quickly in the sum or in the curriculum. Even if you are not reading the curriculum, you can just go to the relevant chapter. In the summary of it, you should be able to get some of this information, all right? So it's a feedback for you, even if you're getting it wrong. It's not a bad thing. Just go back and confirm. And for number 3, it says, which of the following reports is least likely to be filed with the US SEC? Annual report, Form 10K, proxy statement. And the answer is going to be A. The annual report is not a requirement of the SEC. SEC. Annual report, yes, but it's not a requirement of SEC. What will be filed with them is, in this case, would be Form 10K, proxy statements also. Our annual report is not a requirement of SEC. So the correct answer is A, not C. So I can see different responses. Please take note, the one that is least likely is number 1, which is A. It is not a requirement. So go back to your curriculum, you can confirm, even if you are not ready. So you see all those things that go so that you can update your knowledge. Number 4, quickly. Time is against us. It's a battle against time, but we want to maximize it as much as possible. So quickly solve, then provide an answer. I'm expecting you to shower me with responses. I'm waiting, patiently waiting. The following data are available on the company, the metric, and the company, that's in terms of the dollar. So you have the stock price per share, you have the comprehensive income, you have the other comprehensive income, you have the number of shares outstanding, the common shares outstanding in millions. Then on a net basis, the company's P ratio is closest to A. Okay, I've seen 2 A's. Question number 4, Joseph Daniel. Okay, any other person? A, okay, A. Okay. So there's not been any contrary opinion since. Be sure you have calculated yours. Don't just pick it because other people are picking it. They are not necessarily correct. We're almost there. Okay, I've seen B and C now. B and C. So To calculate your PE ratio, you need two things, right? You need your price per share, which has been given to you. And you also need your EPS, that's your earnings per share in this case. All right. So basically, to get your earnings per share, what do we need to do? We said earlier that earnings per share is profit attributable to ordinary shareholders. Profit, not the total comprehensive income. Our focus is on profit, right? In this question, you've been given two things. You've been provided with this, which is the comprehensive income. Then you also have the other comprehensive income. Because what you require is profit, all you need to do is subtract the other comprehensive income from the total comprehensive income, which is basically 193 minus 87.6. So if we check that, you discover that the profit, which is your earnings attributable to ordinary shareholders, or you call it your net income, is basically 105.4. All right, 105.4. So if you miss this step, then that means your answer is already wrong. Take note of that. From this, you can derive your earnings per share. So now that you have the earnings and you have been provided with the number of shares, it is basically your EPS that you need next. And from EPS, you can now move straight to your P ratio, which is the price divided by the EPS. So to get the EPS, it is just divide these earnings by the number of shares outstanding. So what do we have as the number of shares outstanding? We've provided it to us already, which is what? 46.5. So if I divide it, so this is $46.5 million, all right? Remember what we need for this calculation is number of shares. So what happens is that, even though it is not clear from the question, but it seems I have made an assumption that it is $1 per share. So I'm still using the 46.4 or 46.5 rather. So take note. What we need here is the number of shares. So the reason why I need to call your attention to that is if the question is specific that it is not $1 per share. So let's say it is 50 cents per share nominal value. You need to do the actual number of shares. What we are concerned about is the number, the units. So 105.4 divided by 46.5. That gives us what? 2.27, right? $2.27 per share, if I'm correct. And from there, you do the price earnings ratio, which is 60.75. You can just help me with the calculation. You can see I'm struggling to write 60.75 divided by 2.27. 2.27. All right. What do we have? And the correct answer is what? C. All right. You help me with most of the calculations. I don't know. I wasn't able to present with my tab on Zoom, so I'm stuck with a desktop. That's why the writing is slower. Apologies for that. So I want to believe you're able to get the steps. So the correct answer is C. So for everybody that got something else, you should be able to see where you made your own mistake. Very, very important. Thank you so much. Let's go to the next one. Time is running out. So drop your responses. So I know for some people, you're already done with reading, you believe you're 100% prepared. So this could just be a wake-up call that there are some areas you still need to cover. Like I said, no reason to panic. No reason to panic. Just to ensure you are not doing passive reading anymore. Active reading is key. Just keep solving questions, then fill in the gap if you notice any gap. So when you get a question wrong, notice that there is a gap in your knowledge, quickly go back, fill in that gap, then keep solving. So I'm expecting answer to question number 5. B. Okay, remember they are not necessarily correct. So don't follow the crowd. Bring out your own answer. Read it and bring your own answer. More responses expected. I'm waiting for more. A, okay. A. A, okay. Okay. So you can see we're all reading the same question. Probably we've read the same books. Sometimes the difference is all about the number of questions you've solved, because those questions actually expose your weaknesses. And that's what happens. So for people that have read passively up until now, please go back to the drawing board. You need to solve a lot of questions. They open up gaps. They make you see things in a different way, new ways you do things, ways you should not do things, right? How you interpret information and all, and the knowledge that you need to feel. So the following data are available for a company in its industry. Company common size balance sheet as at 31 December 2013. Which of the following statements about the company is most appropriate? So the company, it says, has more financial leverage than the industry. And if you look at the industry, debt to equity is 50%, right? So what is the debt of this entity? Long-term debt. Long-term debt is 20.1, right? Equity is what? Equity is 54. If you check the ratio, I'm not sure that is up to 50%, right? So how did we conclude that it has more financial leverage than the industry? A seems not to be the answer. Calculate what the debt to equity ratio of this company is. 37.22. Okay. So somebody dropped that figure for us already. It is lower. So it's not supposed to be, because it is less financial leverage than the industry. The industry is 50%, which has been given to us here. All right. Long-term debt to equity is 40%. So it's still less than. Okay, B says the company has made significant acquisition in the past. How do we know if a company has made significant acquisition in the past? Something can easily give them away. That is in terms of amount of goodwill they have in books. Remember, under IS 38, internally generated goodwill should not be recognized, never recognized. So if you see goodwill in the books of an entity, it's an indication that they've done an acquisition, whether the company has a subsidiary or not, all right? So there are some acquisition that you do and you subsume the business into your existing business, not necessarily a subsidiary, there will still be goodwill in the books, all right? So if you check now, you see that 40% of the company's total assets is goodwill. 40%. 40%. So B seems to be correct. C, the company is an electric utility. Remember, you have to go through all the options. You are looking at what is most appropriate. What is most appropriate. So how do you know if this company is an electric utility? A simple way to check it is you look at the tangible fixed asset that they have. They are supposed to be heavy in equipment, machinery, and things like that. So if you check the PPE of this company, the property, plant, and equipment is just 3.9%. This is not like any electric utility. They are supposed to be heavy on property, plant, and equipment. So the most appropriate is what? B. So the correct answer is B. I want to believe we are all together. So when you see this type of question another day, you know how to go about it and how not to go about it. Okay, so I have another question presented for you. He said, but there is no goodwill data for the industry. Well, remember, the question is, so 1 minute, please. Which of the following statements about the company is most appropriate? So it's not necessarily compared to the industry in terms of the statement number 2. The statement is saying the company has made significant acquisition in the past. So there's no comparison with the industry. So you don't need the industry data. All right. You don't need the industry data for statement number 2. The goodwill shows that the company has made significant acquisition. Now, in calculating the debt to equity ratio, we did not consider the short-term debt. So you can reconfirm the figure. If you consider long-term debt to equity alone, it is lower than 40%. If you add short-term debt to it to get the debt to equity ratio, it still won't be up to 50%, right? So you can compare the two. So using long-term alone is less than 40%. Using both long and short-term is still less than 50%. So A is incorrect. So we move on to question number 6. Excuse me, please. Question number 6. Drop your answer. Harrison said long-term debt is higher than 40% and debt to equity ratio is higher than 50%. Can others confirm that? Because the calculation given to us earlier was 37.22. Nimi also supported Harrison. Remember, they said long-term debt to equity. Long-term debt to equity. So did you divide the long-term debt by equity? Are you sure you did that? The long-term debt is how much again? And the total stockholder equity is what? So if you divide, what do you have? Please go back to the question in case you have it. So just hold on. Let them finish solving this so that I don't take it off the screen. I'll go back to it to confirm. Once I have the responses, just hold on, don't worry, we'll address it. So debt to equity, based on what Lawal dropped here, is more than 40%. But remember, the industries was 50%. So when what you are looking at is debt to equity, you should be comparing to 50%. If you are looking at only long-term debt, you should be comparing to 40%. Okay, so we already have responses to the current one. B, okay. The Raleigh Builders reported the following financial data for the year ended 31 December. So you have the common shares outstanding 1 Jan. You have the common shares issued as stock dividend. Yeah, that's 380,000. You have the warrant outstanding 500. Net income, preferred stock dividend paid, common stock dividend paid. Which statement about the calculation of LB's EPS is most accurate? So the company's basic EPS is 1.12. Diluted EPS is equal to or less than its basic EPS. The weighted average number of shares outstanding is 2,210,000. Remember, they're asking for some of these questions. You even don't need to calculate anything to get the answer, all right? Calculation could support you. So a lot of people are going for B. B. Remember, it is not necessarily correct. Drop your own response. Drop your own response. Very important. What your own calculator is telling you. It is not a vote. Don't go with majority. Even in a vote, you don't go with majority. You do what you want, eh? The only difference is that in this case, majority will not necessarily win. Okay, B. So we have C now. Okay, so we have BC. Okay, I think we have enough responses, but not as much as what we've been getting since. Which statement about the calculation of LB's EPS is most accurate? LB's basic EPS is 1.12, all right? 1.12, let's confirm that. Remember, when you're looking at basic earnings per share, it is just profit attributable to ordinary shareholders. Then you divide it by the number of shares outstanding. Is that correct? So if you had done basic EPS before, and you should know the treatment of basic things, how do you treat the impact of bonus issue, right? Which we also call stock dividend. How you treat the impact of rights issue, how you treat the impact of new shares that are issued at full market price, right? So you need to note. So the clue for this is that when you have a bonus issue, which is stock dividend, when you have it, you treat it as if it has been given since the beginning of the earliest comparative period presented. So what does it mean? These common shares issued as stock dividend on 1 June, you don't need to prorate when you're calculating the, what's it called? The weighted average number of shares. Remember, if it is an issuance at full market price, you prorate based on time apportionment. If it was done 1st June, that means 7 months out of the year. So it is 380,000 times 7 divided by 12. Sorry, I'm not writing, but at least you can get the gist. But if it is a stock dividend bonus issue, as we have it also, you treat it as if it has been given since the beginning of the earliest comparative period presented. Why? Because it was given for free. The resources of the entity at the beginning and at the end is still the same thing. So it increases the shares. Then we have to do the same thing to prior year so that they will be comparative, all right? You can be able to compare the two. Okay, so 2.2 million plus 380,000. The weighted average number of shares of this company is going to be 2.4 million. No need to prorate. So C is not even correct, which says weighted average number of shares outstanding is 2.210. The weighted average number of shares is just 2020 plus 380, and that is 2.4. Very simple and straightforward. So we have eliminated option C. And to get the basic EPS, you can just help me do the calculation quickly. I'm right. Remember, it is net income, which is 3,350 minus preferred dividend. Don't consider the common stock dividend. What you are concerned is profit, everything that belongs to them, whether they retain in business or they take it as dividend. So what you need as profit attributable to ordinary shareholders is 3350 minus 430. What does that give you? So if you do that and divide it by 240, you get the basic EPS. So the basic EPS is how much? 1.21. Meanwhile, it says LB's basic EPS is 1.12. That is not correct, right? So A is also incorrect. Based on the elimination method, we've eliminated A, we've eliminated C. So the correct answer is what? B. But still, let's check it. LB's diluted EPS is equal to or less than its basic EPS. Yes. Diluted EPS will always be less than or equal to basic EPS. If the potential ordinary shares is anti-dilutive, so that means it has the potential of increasing the basic EPS, we don't consider it. So always, diluted EPS will always be less or equal to, what's it called? Your basic earnings per share. So the correct answer is B. In the real sense, you don't need to do any calculation to get this right. You don't need a single calculation, but we just need to understand that. All right, good. Okay, so let me just address the concern of the earlier commenters on question we solved on number 5. There are still more questions to go, but it seems we've exhausted our time. But I can still use the remaining time to round off properly. So let me just confirm the timing is accurate. Our class is supposed to end at 11:30. Oh, we have enough time, so let's keep going. Good. We have sufficient time to solve. Okay, so let's quickly address this concern. We said, okay, someone said I'm getting 12.1 on EPS calculation. Can someone help? Okay, I think somebody dropped the calculation already. So it is 3350 minus 430 divided by 2.4. Do it again, please. 3350, that's this, minus this, then divided by the addition of these two. It is that simple. So do it again. It should be 1.22. Great. Okay, so let's go back to this. We said debt to equity of the industry is 50%. Remember, 50%. And to get debt to equity of this particular entity, all we need to do is to do the long-term liabilities. We have long-term liabilities, long-term debt, sorry, long-term debt and short-term debt. That's what we are considering. 1.6 plus 20.1. You can do the calculation now. Harrison, I believe is Harrison and Nimi, right? Yeah. So 1.6 plus 20.1. Then you divide it by stockholders' equity of 54 that is sitting here. So this 54. So do this 20.1 plus 1.6, then divide it by 54. That should give you what? Is it up to 50%? Then if you do that of long-term only, so that means you are doing just the long-term debt divided by 54, which is the stockholders' equity. So debt to equity is 40.18. Would you want to just confirm that to us? Ajibola confirmed the same thing. So you can check your calculation again, Harrison and Nimi. Then check the same thing for the long-term debt. It should be less than 40%. So no, not total liabilities. Is debt. Debt to equity, debt to equity. Great. Okay, so let's move on to the next question. I have it presented already. Question number 7, drop responses. What about the current liabilities and other long-term liabilities? In calculating your debt to equity ratio, you are calculating your long-term debt to equity ratio. You are concerned majorly about interest-bearing liabilities. Take note, what you are looking at is leverage, right? Fixed charge on the financings of the entity. So you are concerned about interest-bearing liabilities. So in that, under long-term liabilities, assuming you have different tax liabilities there, different tax liabilities, will you consider it in debt to, and the narration is clear, debt to, not liability to equity, it's debt to equity. So the expectation is that those debts will attract fixed charge. They come with interest obligation. You don't pay interest on all liabilities. So you can't just bring in the current and long-term liabilities. Harrison, does that help? So let's look at question number 7. I'm expecting responses from all constituents here. You are really going to help me with this question. You help me do the calculation and drop figure. I'll just direct you. Hey, no, that's your final answer. You are sure. But you're allowed to change it if you are not sure. You must be sure in the exam. So you have to be sure now, Uju. Okay, so you already have support from 2 other people. 3 now. I believe Shola wanted to write B. So Shola, you can check your option again and write it. Okay. Okay. More responses expected. Okay, so I have C now. I've been seeing a lot of A and B before without C. So some people have C now. Okay, C is now coming in. But it took you people longer to solve. It's now a lot of C. You have to go with an option, Stevie. You said 3.2, 3.0, and 5.4. So what option are you going for? Is it A, B, or C? Okay, B. Okay, that's all right. Okay, so let's look at the question together. You're going to help me do a lot of calculation. I'll just direct you on what to do. So you give me the final figure in the chat box, all right? Thank you. The following data are available on the company. So current year, we have the cash, we have inventory, we have marketable securities, PP&E receivable current liabilities. And on the right-hand side, we've been given some ratios, cash ratio, current ratio, then quick ratio, all right? So the value of the company's liquidity ratio that decreased the most in the current year compared to the prior year is, so we have 3 ratios. So let's take them one after the other. Cash ratio. What's the formula for cash ratio? I believe that is basically cash, right? Do we consider any other thing in getting the cash ratio? Good. All cash equivalents and cash, right? So we are supposed to bring in marketable securities. Fantastic. So maybe some people missed that out already. So if you do your current year's ratio, let's compare it to prior year. So that is 114 plus 23. That should give us 137, right? Good. Divided by current liabilities of 390. What does that come to? So current year, cash ratio is what? So just do addition of this cash plus marketable securities, then divide by current liabilities of 390. And that comes to 0.351, right? Okay, 0.35. Good. 0.35. This writing is okay. 0.35. Okay. So that means it decreased from 0.37 to 0.35. So the decrease is just 0.02, I believe. 0.02. Okay, good. The decrease is 0.02. Okay, fantastic. I saw something now, decreased by 5.4%. Ajibola is not incorrect. It decreased from 0.37 to 0.35. So I believe what you have done is 0.02 divided by 0.37 times 100. Ajibola, if that is correct, just type yes. So that means I'll pick that figure. 0.02 divided by 0.37 times 100%. Is that what you did? Good. So the question did not tell us whether to consider it in absolute or in percentage. So I can't even direct you right now. So let's keep the two. Maybe we will arrive at the same thing. But if we don't arrive at the same thing, I'll make my call. Then we'll go in a particular direction. You know, some of these questions sometimes do have unintended consequences. Okay, so this is the decrease in absolute. If we look at it in relative terms, it's 5.4. The quick ratio now, let's do that of quick ratio. Quick ratio for current year, we are going to consider something in addition to what we consider for cash. And that additional thing is what? So we had considered in cash ratio, we did cash, plus the marketable securities. Then we need one more thing, receivables. Fantastic, thank you. So if you add receivables, the ratio will come to what? So 231 plus 23 plus 114. So divided by 390, just go straight and give me the ratio. So to get the quick ratio, okay. So we said the ratio is 0.94, right? 0.94. Thank you. So 0.94, 0.94. So that means it decreased by what? Okay, I should repeat. So what we considered for the quick ratio is simply cash. Look at the ones I marked, cash plus marketable securities plus receivable, addition of the 3, then divided by 390. Oh, Nimi, you change your mind. Okay. So what do we have? The decrease is what? 0.03, is that correct? It decreased from 0.97 to 0.94. So that is 0.03, right? Okay, Joseph said that is a 3.1% decrease. Since we are using the same method as the first one, let me keep it by the side. Not necessarily going to be the same answer, but if it's coincidentally the same, good for us, and we move on quickly. Okay, quick ratio. Sorry, current ratio now, which is the last one. In addition to the 3, what else are we going to add to it? All you need to add now is what? Property, plant, and equipment. Am I correct? Just add property, plant, and equipment and move on. Oh, it's inventory. Oh, thank you. Oh, great. So it is cash plus marketable securities plus inventories and receivables. Good. So divided by 390, what do we have? So give me the ratio, please. That is 0. What? Let me not jump that to 0 point something. 2.12. Is it 2.12 or 2.13? Let's be sure. Because that thing is material now. You can see the difference among the first two, between the first two. Okay, 2.13. Okay. 2.13. So that means it declined from 2.19 to 2.13. That is 0.06. Right? Good. So the one with the most decrease compared to prior year is what? Okay. So now, this is now the difficult place. I can see Ajibola is saying 3.2. Is it 3.2 decrease? Joseph is saying 2.4. Which one is correct? If I want to use the relative terms. .7 is the correct one. Okay, so you can see that it's even a total deviation from if you are using the absolute term. And it's asking for the most decrease. If we conclude based on this absolute, the answer is going to be C, which is what I'm going to do normally. But with this, your method, unfortunately, I can't tell you that you are wrong. You have not done anything wrong because you have looked at it in relative terms, and the question wasn't specific to say, oh, that has declined in absolute or in relative terms. So what I will just do is my own conclusion will be that since it is not specific, it says the value of the company's liquidity ratio that decreased the most in the current year compared with the prior year. All right, compared to the prior year is the most. Yes, you are not wrong for interpreting it the other way, but my answer is going to be based on this, which is just a direct comparison of the two and looking at the difference between the two. So we are going to go for C. Unfortunately, I can't totally refute you that, oh, no, you are wrong, because what you have done is to look at in relative terms, what is the decline, which is not totally wrong. But for this particular question, the absolute seems more appropriate since it is not even specific now. So the one that declined the most is that, yes, we had 2.19 for current ratio before, and it has now declined to 2.13. So we'll be going for option C. I'm not saying you cannot contest it, but unfortunately, no BG. Only one question. Yeah. Okay, good. Yeah, hey, thank you. For peace to reign, right? Yes. Like I said, I never mentioned that you are wrong. See, I cannot say that you are wrong. The reference was to value, so absolute is more appropriate. Thank you for supporting me, Harrison. I think since prior years in absolute, then absolute is more probable. Correct. So thank you for supporting me. I have so many lawyers on my back here. Well, even if they give it to you this way, the relative could still be used to interpret it, but we'll go for the absolute. Yeah. Adopting all the argument of my counsels. So C is the correct answer for number 7. Let's go to number 8. Quickly, we have more questions. I've gone for percentage since we are looking at ratios. Strong argument left, right, and center. B, C, B, C, B, C for number 8, right? I've not seen anybody going for A. Okay, a lot of B. I've seen C also. The question says, which of the following is most likely a benefit of the direct method for reporting cash flow from operating activities compared with the indirect method? The direct method, A, mirrors the forecasting approach normally used by analysts. It does cash receipts from customers, cash paid to suppliers, cash paid to maybe employees, then the cash paid to government, which is taxes. All right. Is that the forecasting approach normally used? Okay, let's look at other options. Provides details on specific sources of operating receipts and payments. Yes, remember the difference is always coming from the operating cash flows. And what we do for indirect method is we just reconcile. So it doesn't provide information on where the cash flow is coming from. So direct method actually does B, all right? C, it provides insight on differences between net income and operating cash flow. That is actually the job of the indirect method, not the direct method. Okay, so B is correct. It provides details on the specific sources of operating receipt and payment. And that is the major advantage. You know where the cash is coming from. So what is driving the cash inflow from operating activities? The net inflow or outflow in operating activities will be driven out by something. When you look at the reconciliation done under the indirect method, you don't have that insight. But when you use the direct method, you can know, is it that we are not collecting enough money from customers or we are paying too much to suppliers? Maybe we are not exhausting our credit period or whatsoever that has led to that. Provide details on specific ones. Correct. So B is correct. Please take note. Number 8, the correct answer is B. That's what it does. That's what it does. All right. Okay, so let's move on to the next. Moving on to the next. Quickly, time is running out. You have to start from the formula for this. Can you remember it? I'm waiting. Not seen any response. C 2.27. Okay. C. Okay. Yes. Noted. Thank you. Okay. Remember, we have 10 minutes more. We've gotten to the concluding phase. A good Samaritan should help me write out the formula for fixed charge coverage ratio in the chat box. A good Samaritan. A good CFA candidate. Okay. EBIT plus lease payment. Good. Divided by interest payment. Is it minus? Interest payment minus lease payment. Is it minus? Sonia, check that formula again. It should be plus. Good. So if we apply this, you need to calculate your EBIT first. And simply that one is going to be your net income, right? You add something to it, then you deduct something. So you're adding interest expense. You're adding your income tax expense. Nothing to deduct. It is not a credit. So it's an expense for interest and it's an expense for income tax. So if you add those two to your net income, it gives you your EBIT plus lease payment. You have to do that. Divided by interest plus lease payment. So I can see people are recalculating now. So if you follow that formula, then your answer is what? Your earnings before interest and tax. Let's start with that. So just do for me 34 plus 11 plus 1,000. That gives how much? Despite writing the formula, we are still getting different answers. I thought that we unify our answers now. Good, 5,005. I'm seeing 5,9. Please check it again. 34 plus 11, that is 45, plus 1,000, that should be 55. Oh, yeah, good, 55. So if you add lease payment to it, that should be 6,000, right? It will now be divided by interest plus lease payment again. Interest plus lease payment is 1,000 plus 500, right? So it's going to be 6,000 divided by 1,500. Remember, you are still adding lease payment to the 55. The EBIT is 55. Your EBIT is 55, right? Plus it is your EBIT plus the lease payment divided by interest plus lease payment again. 4. The answer is 4, right? That is B. Good. So it is B. B. Good. 6,000 divided by 1,500. So you get your EBIT, which is 34 plus 1,000 plus 100 plus 11 rather. So these 3, if you add them together, it gives you earnings before interest and tax. Then you add lease payment to it to get the numerator of 6,000 divided by interest plus lease again. Interest expense of 1,000 plus lease payment of 1,500. All right. Good. Good. Thank you. Okay, I think I'm not sure we'll have enough time to take another question. Okay, the question is simple and straightforward. So take one more, then we call it a class. Then we can move on to other topics. So number 10, then we conclude. Okay, I think somebody wrote B already. B, B, B. A, C, B, okay. So far, please go back to all the responses you gave. Just 10 questions, right? Out of the 10 questions, how many did you get correctly? If there's anybody with 100%, please signify. Don't worry, the evidence is there. I will audit it. 100% of what we've done so far. C. Okay. Okay, so to close it, we said which of the following is most likely classified as a current liability? It says payment received for a product due to be delivered at least 1 year after the balance sheet date. Will that be current? Will that be current? Oh, that's great, Joseph. Good performance. Which of the following is most likely classified? A is unlikely to be, that is consideration received in advance, right? You have not provided the service, you've collected money, then it means that because the goods will be delivered at least 1 year after the balance sheet date, you cannot recognize revenue until performance obligation has been what? Satisfied. Oh, please read carefully. So that is going to be non-current. B says, payment for merchandise due at least 1 year after the balance sheet date, but still within a normal operating cycle. I think in the course of the lecture, I mentioned this. When we say current, it is not necessarily only shorter or 12 months or less, right? Some companies have their normal operating cycle longer than 12 months. Think of a construction company, all right? The normal operating cycle could be longer than 12 months. So what we consider as current is what will be realized in the normal operating cycle, right? If shorter than 12 months, then you consider 12 months, right? So for some, their own operating cycle is longer than 12 months. So that means what we are looking at is the operating cycle, not the 12-month limit. The 12-month limit will apply for a company that is shorter than normal operating cycle. Its normal operating cycle is shorter than 12 months. Okay, so even though it is at least 1 year after the balance sheet date, but because it is still normal operating cycle, it is still going to be current. It is still going to be current. Payment on debt due in 6 months for which the company has the unconditional right to defer settlement for at least 1 year. Because there is unconditional rights, what happens? You present it as non-current. So there are still other questions in there. Unfortunately, we're out of time. I will not be able to go through them. So remember, you need to go back. I already mentioned something earlier. Active reading at this point. You don't want to be reading passively. So many things to read. And if you keep reading and reading over again, it's always as if you've not read anything. It's not because something is wrong. That is the normal thing, all right? It's the normal thing. So take your time, go over all these topic areas, think of what we've discussed today, go over them again, solve a lot of questions, and that is really going to help you. Thank you for having me. Do enjoy the rest of the day. Bye, everyone. Okay, so I think we'll just wait some minutes for Wale to come in for economics. So everybody just be on standby. The next lecturer will be on soon.
Thank you, Dimeji. Just 1 second, please. Okay, Wale, you're welcome. You can go on.
Okay. Good morning. Can we all see my screen? Okay. 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 Just from there. Yeah. So the economics module essentially just has 7 topics, 2 study sessions, and 7 readings. What we'll try and do to make best use of our time is we'll try and run through as quickly as possible. I would look to start with the currency exchange rate reading because I sort of think that a lot of students always have issues there. So I'll just try and run through that because there are quite a number of calculations there which always come up in the exams. So I'll try and run through that, and then we come back and go through demand, supply, and GDP growth, and then hopefully we have time. We'll run through monetary, fiscal policy, and trade flows. All right, so I'll just move my slides quickly to the currency module. Oh, sorry, my voice is low. Can you hear me now? Am I clear? Okay. Okay, so I'll just start with reading on currency and exchange rates. So what the curriculum wants an understanding of is basically what exchange rates are, trying to identify, define direct and FX quotations, interpret currency changes in nominal and real terms, and also do some calculations on currency exchange rates, forward exchange rates, trying to interpret forward discount premiums, and then just touch on some theoretical issues, exchange rate regimes and exchange rate, the impact of exchange rate on international capital flows. So what I think is just the basics. We'll start with just the basics, which is trying to, what's an exchange rate? So an exchange rate is, my screen is on slideshow. Okay. Okay, so what an exchange rate essentially is it just looks at the price between 2 currencies. So often very important is to know the price and base currency notations. And I'm just trying to use it here in Nigeria. So what the Naira dollar exchange rate is. So the price currency is the currency to which the code represents 1 unit. That's the base currency rather. And the price currency is the currency for which the code represents a number of units. So your base is usually the unit of currency that's coded as 1 unit, whilst the price currency is the currency that is coded as a number of units. So for example, the price to base, if I use the Naira dollar, $1 US is 410 Naira, 50 kobo. So the price currency here is 410, whilst the base currency is $1. The quotation to often notice that is often quoted as NGN USD. So what it means is that the price currency is the number of units, and the base currency is the currency that is quoted as 1 unit. So in this case, $1 is 410 naira 50 kobo naira. So essentially, what is good to note this quotation, because oftentimes this is how the curriculum works. This is how the material works. The price currency is the currency, the base currency is the currency that is in one. So $1, and the price currency is the currency to which the base currency is expressed as a unit in units. So that's the price currency. A decline in the price currency represents, in this case, so if the exchange rate of 410 naira goes down, and that was if the number goes to say 400 naira, that represents an appreciation in the price currency and a depreciation in the base currency, and vice versa as well. So if the number goes higher, however, so if it goes from 410 to 420, it represents a depreciation in the price currency and an appreciation in the base currency, all that way. So important to note that. Next thing to also note in currency is the relationship between your nominal and real exchange rates. So your nominal exchange rate is your spot exchange rate, 410 naira 50 kobo. That's your nominal exchange rate. While your real exchange rate is your nominal exchange rate adjusted for currency changes, for inflation, rather, inflation. So as the name implies, real. So it's given by the formula, your real exchange rate. Now, DF here means it's quoted as domestic foreign. So in other words, your domestic currency is your price currency, and your foreign currency is your base currency. So if you have that notation, then it's given by your nominal exchange rate and multiplied by your inflation, which is your CPI, and your foreign currency over CPI and your domestic currency. Now, the change in real exchange rate, essentially, I have an equality sign there, but it's actually an approximation. So an approximation is your change in your nominal exchange rate plus foreign inflation less domestic inflation. Now, what this just does is they just entirely did a linear approximation for the first. So if they've given you, say, the Naira dollar exchange rate falls by 5%, and the foreign inflation, US inflation is 2%, and Nigerian inflation is, say, 12%, you can work out what the change in real exchange rate is. So in this instance, that would be, the example, as I said, the change in nominal exchange rate is, say, 5%. Let's assume it's 5%. And the foreign inflation rate, US inflation rate is 1%, and Nigerian inflation rate is 12%. So what that means is that if you add 5 plus 1, that gives you 6. 6 minus 12, that gives you minus 6%. So the change in real exchange rate would be minus 6%. Now, important is, how do you interpret changes in real exchange rates? A change in real exchange rate, a positive change in real exchange rate. So in other words, if once you work out this equation, if the sum you get is a positive, it means that purchasing power has declined. So in other words, if the number, let's say you worked out your change in real exchange and you get a, say, 13% number or 12% number plus 12% number, it means real purchasing power, relative purchasing power has depreciated to people in the domestic economy. On the other hand, if the number is a negative, it means it has appreciated. Their purchasing power has increased, and so it's also good to sort of know that approximation. Long-term real exchange rates are not observable in the short run. So people tend to say they're a poor predictor of FX movements over a long period of time. It can also be computed for a basket of currencies, so as to reflect country-to-country trading, which is what people call as real. So you also have the spot and forward exchange rates. The spot and forward exchange rate is just your spot rate is just your exchange rate available for immediate delivery, or T+2. T+2 means available for delivery in at least 2 days. So in other words, you conduct a dollar transaction, and if it's available for immediate delivery or at least T+2, is a spot transaction. In the CAD, you also have T+1. A forward exchange rate is also an exchange rate for anything in the future. Its name implies typically 30 days, or anything longer than T+2, 30 days, 60 days, 90 days. some feature that does a forward exchange rate transaction. Another thing to also note is also your direct and indirect quotations. Now, direct and indirect quotations is just from the perspective of an investor, the domestic currency per unit of foreign currency. So in other words, for a Nigerian investor in this example I've used here, a direct quotation is $1 is 410 naira. That what that does essentially is it sets the price currency as your domestic currency, your base currency as your foreign currency. So that's 14. Now to get your indirect quotation, you simply invert your price, your direct quotation. So in other words, you flip it the other way around, and what you just do is divide it by 1 divided by 410. That gives you your indirect quotation. Like I said, just take the reciprocal of your direct quotes. I will do some examples where maybe I'll try. I think we'll try and do some now. We'll do some examples when we get to the end. Yeah, then you also have bid and offer, bid ask, bid and offer. Always know the bid is always lower than the offer. Then yes, one thing to also notice that currencies tend to be quoted in 4 decimal places except the JPY, well, and for Nigerians and the Nigerian naira as well. But on currency appreciation or depreciation now, and this is very important because more often than not, most people when they say the currency has moved from, like I use the example here, the currency has moved from 386 to 410 naira. This represents a 6.2% appreciation in the US dollar and a corresponding depreciation in the naira, or a 5.9% depreciation in the naira. Now, what most people compute more often than not is that don't make the mistake of switching the 6.2 for 5.9 for the naira and the other way around. I don't know if you get what I'm saying. So what some people do is they just say 410 divided by 386 minus 1, and then they get 6.2 and say that's depreciation in the currency. It's not actually the correct thing. That's actually appreciation in the US dollar against the naira. To calculate the depreciation in naira is 306 divided by 410 minus 1. That gives you 5.9%, which is the depreciation in the naira. It's not a mirror image. They're not mirror images. In other words, don't just say, well, just take away the minus sign, it's plus. It's not a mirror image. They are two different things entirely. It's always good to have that a currency depreciation. So if you're using a price to base currency, the percentage change in the price currency is going to be the price over the initial over what it has become. That's the old price over what the new price minus 1. That gives you the depreciation in the price currency or the changes in the price currency. If you want to check in the base currency, we use the new over the old, and then that gives you the change. We'll do examples of that. But like I said, if you were to compute it for the Nigerian naira, in this example I've used, if you got 6.2, that's 6. If you did 410 over 386 minus 1, that change is appreciation in the USD, not in the naira. To get the change in the naira is 386 over 410 minus 1. That's 5.9. That's the percentage change in naira. Okay. Next thing we're going to calculate is cross exchange rates. Cross exchange rates essentially is the percentage change between. So typically, a lot of currencies are not very liquid. Outside the major G10 currencies are not very liquid, and so what you don't tend to have direct quotations between two countries. For example, in Nigeria now, if you wanted to exchange a naira for Ghanaian cedis, there's no direct quotation between those two because the market is not very liquid. So you don't have a very liquid market. So because you don't have a very liquid market, what people do is they look for a third currency where there's between those two currencies. So naira and dollar, for example, naira dollar is liquid, dollar cedis is liquid, and then you calculate an implied cross rate using those two rates. I think I'll just pause here to do an example. Maybe we'll do that later. Let's just do that. Slideshow. Okay. I'll just pick one up. Okay. So just Okay. Just switch it. Stop sharing. Share screen. Okay. So we have this example of cross exchanging. I don't know if everybody can see my screen here. So they say a research report by a dealer includes the following. So you're giving several exchange rates. The spot CHF euro cross rate is closest to. So you're giving. So what we have here, we're giving three exchanges. We're giving a euro dollar quote, a Swiss franc dollar quotation, as well as a USD pound quotation. So we're asked, however, to find the cross rate between the euros and the Swiss franc. So in this example, what we're being asked to look for is the CHF. But we know that we don't have a direct quote here, but we can see that there's a relationship between the euros and the US dollar, and there's also a quote that shows the relationship between the exchange rate between the Swiss franc and the US. So we can work out what a simple relationship here. So we have CHF USD, and we also have USD Euro. So from here we have a common currency between the two. So what we can do is we can multiply, because if we take this out, we have our CHF euros transaction. So if we multiply, what we just do is, because we have a common currency between the two, we multiply the spot rate here with the USD rate here, and that gives us our, because what we have left is our CHF euro, which is exactly what we're looking for. So if we work that out, has anybody tried it out? Multiplying it. So okay, someone says the answer is C. That's 0.8456. Next thing we'll do is GBP euro. So question 2, GBP. Oh, somebody has 1.1158. Yeah, so that's it. So yeah. Okay. Next thing we'll do is GBP euro. So for GBP and the euro, so what we have here, we have a relationship between the US dollar and the euro, and we also have a relationship between USD and GBP. So what we're looking for, however, is the relationship between a cross rate between the GBP and euros. Now, so we're looking for GBP euros. We have USD euros, and we have USD GBP. Okay, someone says you can't see my screen. Can you see it now? Okay. So what we'll first of all do is, the first thing we'll do in this case, unlike in the other case where we just did a direct multiplication, remember what we're looking for is GBP euros. So in other words, we'll first of all need to invert one of these, preferably this guy. So we'll flip it, GBP USD. So we'll take the inverse of this. By the time we take the inverse, that gives us USD euros, which if you cross this out, we're exactly what we're looking for. So the first thing you do is you take the inverse of the exchange rate between the GBP and the euro. So 1 divided by that exchange rate, and you multiply it by your USD euro exchange rate, and that gives you what we're looking for. So you take the 1 divided by 1.3188, and then when we get this, the output, we multiply it by 1.17018. So yeah, so I see a lot of people have also clicked on that as well. So yeah, so that's how you work out the cross rates between currencies. Just to run through some of the questions you have here, which they typically always sort of play around with. They say based on the exhibit, the euro is expected to shape by how much against the US dollar over the next 1 year. So you have the euro dollar exchange rate here, right? you have the euro-dollar exchange rate here. And then you see over the next 1 year, the spot rate is given by 1.1701, expected to fall to 1.1619. Now, remember, the euro is the base currency, the dollar is the price currency. If the rate is coming down, how are we going to work it out? So so remember, as I was saying, you're always going to use your 1.1701 divided by 1.1619. If you did the division and subtracted your product from 1, you're going to get a number. That number is most likely going to be it's most likely going to it's most likely going to show an appreciation. It's going to be an appreciation, right? So anybody work it out? Anybody work it out? Yeah. So it's going to give you an answer of so now that's the I see a lot of people have, but now let's calm down. I see a lot of people have put it as B straight away, but they've played a trick on us here. This answer is actually appreciation in the dollar, not in the euros. This answer is actually an appreciation in the dollar and not in the euros. So they've played a slight trick on us here. This question here actually an appreciation in the dollar. So if you were to get the appreciation in the euros, you would have to work it around. So because if the exchange rate is coming down, so euro depreciated. So exactly. So the answer is 0.7. So they played a slight trick. -7, yeah. So if we just scroll down, I think we'll see it. Yeah, it's -7. So the answer is A actually. So it's -7. So they played a slight trick because they knew that, I mean, if you look, remember, it is your price to base currency. And that's what I'm saying. Your price currency is your USD. So if you compute just on that relationship, it will show you a what? It will show you that the exchange rate has come down, but that's actually USD appreciation, not euro depreciation, not the euro, not a change in the euro. That's actually a change in USD. If it's a plus sign, to get the other way around, you actually have to do it the other way. You have to, so that's how you get it, a -0.7. So they just played a slight trick. Okay. So based on the exhibit, let me just clean up a bit. Based on the exhibit, the dollar is better to appreciate by how much against the pound over the next 1 year. So here again, I mean, the dollar is going to be, so now this one, everybody should get this one, right? This one is, they try to play the same trick, but everybody should get this one. So the answer should be plus. Yeah. Okay, so I think we're done with that. We'll just go back to material. So, okay, so everybody's okay with this. So just stop share and go back to the material. Okay, so the next thing, once we've known how to figure out the cross currencies, is FX. Okay, so just some conventions, further conventions on the FX markets. Conventions on the FX market. So your forward quotations typically, so you have forward, as we talked about earlier, you also have a forward and spot trade. Your forward, as I said, is anything above T+2 in the future. Settlement, whereby settlement is you buy or sell exchange rate, but we settlement in the future beyond T+2. So typically, dealers will quote forwards there are different ways they typically quote forward. They can quote it as on a points basis, typically called pips, which is just the difference between your spot rate and your forward rate times 10,000. For the Japanese yen, is 100. or they could quote it as a percentage. In other words, as a forward rate, which is a percentage of the spot rate. So in other words, the forward rate is given by your spot rate times 1 plus your forward point. So typically they will tell you, oh, let's say $9, or the 6-month forward rate is 10%. So that means if you wanted to get the forward, so it's expressed as a percentage of what the spot is today. So like 10%, you typically quote as a percentage. And I said to compute that rate, what you just need to do is your forward point, you typically as a percentage plus 1 times your spot rate. So you typically have forward currencies trading at either a forward premium or a discount. Now, and I use an example here. The euro dollar is trading at 1.2345. This is an example, not real. The forward rate is given by 1.2360. So that means if you take the difference between the spot and the forward, is a premium. So that's because the forward rate is higher than the spot rate. So what that means is that the currency is trading at a premium. So, and specifically what that means is that the base currency is trading at a forward premium to the price currency, in which case the euro is trading at a forward premium to the dollar. That's if the forward rate is higher than the spot rate, and that's the differential is positive. If the differential between the forward and the spot is negative, then the currency is trading at a discount. In other words, the dollar is trading at a forward discount to the euros. So yeah. So when I just try to explain it here, so if the forward rate is lower than the spot rate, then the currency is trading at a forward premium. If it's trading lower, it's trading at a forward discount. Yeah. So now what we just the next percent of the material tries to just what's the relationship between forward rates, spot rates, and interest rates. Because these three relationships pretty much always sort of, and to understand that, it's always good to sort of think of a currency transaction as that you have two options. What informs the forward rate is often given by an arbitrage or a no arbitrage condition, and I'll just try and explain it briefly. So you're an investor, you have two alternatives. One alternative is let's say you have 100 naira today. Let's assume we're a Nigerian investor, you have 100 naira today, and you can invest it, say the 1-year treasury bill rate or 1-year risk-free rate is 10%. So in other words, if you invested that 100 naira in domestic risk-free instruments, you get at the end of the year 110 naira at the end of the year. That's what you get. However, on the alternative, however, you can also say, well, domestic investment is boring. I want to go and get something elsewhere. So you have an option whereby, let's say you have the option of going abroad to go and invest in say the South African rand, in South Africa. So you could convert your naira to dollars, which is convert it to rand, and then invest in a risk-free rate in South Africa. That's whatever the risk rate, 1-year risk-free rate. Let's say is 20%. Again, just examples here. And at the end of the 1 year, you would convert back to Nigerian naira at the end of the 1 year. Now, the option that makes sense to you is where you find now the forward rate, which is your forward exchange rate, should be such that you are indifferent between staying in Nigeria and investing in a 1-year risk-free rate and going through that whole process of converting your currency to South African rand, investing in South African rand, and you should be indifferent. Because if you really look at it, if you are investing in risk-free securities, in other words, there's no risk of default. In Nigeria and in South Africa, there's no risk of default. The only risk you face is your exchange rate risk. And if you've entered a forward contract with somebody, a credible counterparty, then the two transactions should be the same thing. Otherwise, it's an arbitrage condition, and you can exploit that arbitrage by trading in one currency. And it assumes, of course, that currency markets are liquid and there's no issues with liquidity. So under that no arbitrage rule, that's how economists believe the forward rate should be set. Or that's how people believe the forward rate should trade. Or that's what people believe the forward rate should be set at. And so it is a no arbitrage condition. You're either on the local side earning your local risk-free rate, or you decide to convert your currency into your local currency into a foreign currency, and the foreign currency risk-free rate. At the end of the 1 year, you convert back to your local currency. These two transactions, local, domestic, foreign, should give you the same return. If they don't give you the same return, there's an arbitrage condition. And people believe that because financial markets are efficient, they always trade away any differences or any mispricing in between. So what economists have been able to work out for is that the formula for the forward rate, if you're trying to relate it to interest rate, is the spot rate multiplied by the a ratio of your 1 plus your interest rate earned abroad plus 1 plus your interest rate earned domestically, which if you scale it for time, let's say you're not investing in 1 year or standard time periods, you can adjust to this. It's something like this. We'll do an example, so we'll make it a bit more practical. Now, the general rule is that the currency with the higher interest rate will trade at a discount in the forward market, and vice versa, or the currency in a lower exchange rate will trade at a premium in the forward market. And that's the general rule. So if you typically what they do in the exam, they show you two currencies, one has a higher interest rate than the other, or maybe they give you a currency and they tell you it's trading at a forward premium. What that implies is that then they can ask you, okay, which currency has a higher interest rate than the other if this one is trading at a forward premium or discount, or they can give you two currencies, one with a higher interest rate, lower interest, and ask you, okay, which of these two is trading at a forward discount or premium. So the general rule, I said, is that it's expected that in finance, in economics, rather, that the higher interest currency with the higher interest rate should trade at a discount relative to the currency with the lower interest rate, which should trade at a premium. Now, what this implies theoretically is that the forward rate is a very good predictor of the spot rate. Sorry, but is that true? Some people will argue otherwise, which is why we have carry trade opportunities, because carry trade opportunity is built on the idea that if the forward rate is not a very good predictor of the spot rate, and I'm an American investor, interest rates are 2%, and there's an opportunity to go and invest, say, 10% in, say, Nigeria or Ghana, I could convert my exchange rate. If at the end of the day, the exchange rate does not move that much from where its spot is, in other words, the forward exchange rate contract is not a big deviation from the spot, then of course, I can actually harvest any higher interest rate, which informs carry trade. So carry trade just goes to try to prove that, look, in all instances, the forward rate is not a very good predictor of where the future spot rate will be. So there's opportunity for carry trade. Just trying to show here, what they just read is that the forward interest rate is the arbitrary condition of my head, and the forward coins typically are time scale for interest rate differential. So we'll just do some examples so as we all get comfortable here. Okay. Yeah, so here, typically the people who engage in forwards typically are companies. So for example, this example we have here, a French company based in France is expected to receive 50 million pounds from a UK customer in 32 days, that's roughly in a month. And so the treasurer wants to hedge against the risk of that transaction, which is why people use forwards, really. If you're going to receive a foreign payment or you are going to make a foreign payment, a payment in another currency, then what you typically want to do is you want to hedge against any risk around exchange rates moving against you by entering into a forward transaction. So that if you enter a forward transaction, you lock in the exchange rates and there's no risk around payment. So he's going to receive this amount. And the question is that, so this is the spot rate, and this is the 1 month forward points. So based on this, how could he, first thing is, so they've given the data, the treasurer could hedge this foreign exchange risk by, and before even going to work it out, he's going to receive GBP, but he's based in France, which uses the euros. So what does he really want to do? He definitely wants to be selling British pounds, because what that means is that he's going to receive this GBP, but he doesn't need GBP, so he needs to sell it to somebody else. So the transaction he'll be entering into will be a sell GBP transaction. So definitely you can rule out option C from here, because it's definitely not option C, because you're not going to be buying GBP, you're going to be receiving GBP. So you're going to be either A or B. So how do we work out what exchange rate that is going to be? So we use the 4 point. Remember our formula for forward points, for our formula for the forward rate. The forward rate is given by your spot rate times your forward points multiplied by 10,000, and that's it. So see, for forward rate plus rather your forward points multiplied by 10,000. So what's the answer going to be? Somebody work it out. So they're giving you your forward point, which is 1.4. Sorry, no multiply, divided by 10,000. Sorry, will be divided by 10,000. Then you add it to your forward points. That's because let's go back again of our forward formula. So let's go back to the formula. Our formula for forward points is given by your forward point is equals to your forward rate minus your spot rate times 10,000. So in this instance, we know what our 4 points are, we know what our spot rate is, so we can just play around with the multiplication. So that means it's going to be given by our forward rate is going to be given by our spot rate plus our forward points over 10,000. So if we do that, so minus 1.4 divided by 10,000 plus our spot rate, which is 8.742, we're going to get our answer. So yeah, so a lot of people are already saying it's, the answer will be so yeah. Our answer? Yes, our answer is that. So yeah, 87506. So that's our answer. So the best interpretation for the forward discount shown is that, so now here, this is it. This is now where what I was talking about earlier. Is it that the euro is expected to depreciate over the next 30 days? It's possible, but the question is asking you for the best interpretation. So in other words, what's the best of the best? 1 month UK interest rates are higher than those in the Eurozone. Is that the case? Remember, our theory was that the currency with the higher interest rate will trade at a discount, while that with the lower interest rate will trade at a forward premium. Now, what we see here is that the forward points here is negative. So clearly, the currency is trading at a discount. The forward premium is the forward is a discount. It's a discount to the spot. So we have a case of a forward discount. And what it says is that if a currency with a higher interest rate will trade at a discount, and a currency with a lower interest rate will trade at a premium. So which of those two currencies is trading at a discount or a premium in this example? Is it the euro or is it the GBP? For the exchange rate to be like this? Any takers? Any takers? Euro. So some people say the euro clearly has higher interest rates than the UK. Euros. Okay, we have one taker. Let's just go back here. Yes, so the answer is the euros. The euros have a higher interest rate. We see, yes. So the answer is C. The euros are trading at, and that's because, as we said earlier, the currency with a higher interest rate. In which case here, the forward point is at a discount. So because the forward point is at a discount, it must be that your base currency is trading. What you're saying is that your base currency is trading at a forward discount. In this case, the euro is trading at a forward discount. So clearly, if the euro is trading at a forward discount, it must be that the euro has higher interest rates than USD, than the GBP. Okay, so they then ask the 12-month forward rate is given by, sorry, somebody asked a question. Why we exclude A? Okay, A is just really, the question is could it happen? So what the way to look at it is that they ask what is the best interpretation? The best interpretation. So is it that the euro is expected to depreciate? Yes, it's possible. But is that the best interpretation? You can't necessarily always say this. The expectation is that yes, it could, it should depreciate, but a lot of things could happen. That's the sense I get. So, but I think if you had to pick between A and C, the one you know that is for sure is more likely a C. So in other words, it's more likely that it's trading at a discount, interest rates are higher. That's why it's trading at a discount than you expect it to depreciate. I mean, expectations could vary over the next 30 days. And again, this is just one dealer. So again, I guess that's the way I interpret it. So they just think, well, if you had two options, which one is more truer or best is a better case, is more likely C than A. And so that's the way I would go with it. Okay. So so the next question then says, if the 12-month forward rate is given by 0.87925 and based on the forward, then the forward points are closest to. So again, we just use our forward rate formula and we work it out. So the answer there would be, I think, it would be 22.5. I think. Use that. I think the last example, the one I want us to walk through is I think it's number 5 here. It's number 5 here. So you're given 270-day LIBOR rates for the euros and GBP at this and this, and the spot rate is this. Number of forward points is closest to. So if you wanted to work this out, remember our formula for the forward rates. The formula for the forward rate is given by foreign domestic is equals to your spot rate, foreign domestic, and then your foreign exchange rate divided by 1 plus your domestic exchange rate. Now you scale it to 270 days. The interest rate will be scaled to 270 days. So what they're giving here is an annualized rate. So you have to scale it to 270 days because the question is asking you for a forward rate around 270 days. So the first thing we'll do is we calculate our forward points. Then from our forward points, we calculate our forward rates, and then from our forward rate, we can get what our forward points would look like from there once we know, because we have a spot rate here. So in formula terms, 8489. Our foreign currency here is the euro. So 1 plus. Rather, our foreign currency here is GBP. Yeah, our foreign currency is GBP. So the GBP rates are 1.325. Now you're going to scale it by 270 over 360. In other words, you're just going to scale the interest rates to the tenor, to the 9 months tenor. So you do the same thing for your 1.37, 270 to 360. And we'll work that out. Once we get that, we'll get I don't know if anybody has tried that, anything like A. Some people are already hitting on A already. People are fast. So if we work that out, you should get, yeah. So something like so the way they have it here. So yes. So if you look at it, that's exactly the same thing they have. So okay, yes. So they make that a percentage. So don't forget it's a percentage. So yeah. And then we have this. This is our forward rate now, not our forward point. To work out what our forward point is, we subtract this from our spot rate, and that gives us our forward point. So we take the forward rate that we've obtained, multiplied by our spot rate, which we've been given, and that gives us our forward point. And then we scale it scale it appropriately. So we multiply it by 10,000. What some people also do is there's another way you use a forward swap formula, a swap points formula, which is more exact and which is more exact, but I think swaps are really level 2 questions. So okay, yeah, I think that's what they also. I think now we know how to calculate forwards. I think how to work out what the forward rate is, how to calculate the forward rate. I mean, every time you're giving a forward rate question, really, it's always going to involve your ability to play around. I'll just pull it up in a bit, around this formula, really. It's always going to revolve around your ability to play around this formula. So if you can identify what your spot rate is, you can identify what your foreign currency is, and your domestic interest rates are, then your T is given by your time period. So it's usually less than a year. If it's a year, then it's fine. But less than a year is whatever that time is over 360 days. Every year is going to be 360. So you'd always play around it. So typically questions would always play around your ability to be able to think through this fundamental relationship here. So in other words, the forward rate is given. So if you can identify what your spot rate is, your foreign currency is, your domestic currency is, and then your time period, you would always be given something like maybe say, okay, your forward rate is this, you have this interest rate, what's the spot rate, or things like that. So you should always be able to play around. The questions, the exams typically always involve you playing around things like that. Yeah. Next thing on that currency is exchange rates regimes. An ideal currency exchange rate regime has 3 properties. One, the exchange rate between 2 currencies are credibly fixed. Currencies are fully convertible, and each country is able to undertake fully independent monetary policy in pursuit of whatever doing. So in simple language, the exchange rate between 2 currencies is fixed at the level that everybody agrees with, is fine, and there's no change. It's stable, a stable fixed exchange rate. Second thing is all currencies are convertible. So in other words, you don't have an instance where, because of illiquidity, some currencies are more liquid than other currencies, in other words, you can freely convert currencies across different countries. And then lastly, each country is able to undertake full independent domestic monetary policy. Each country is able to undertake full independent monetary policy. So under those conditions, however, what is found is that typically you will never have all 3 in one case. What you're going to have is either 2 or you never have all 3 working. So there cannot be an ideal currency regime. What you find is countries typically chase 2 and ignore 1. This is part of what is called the impossible trinity. So you chase 2, you ignore 1. Most exchange rate regimes are sort of trying to play around this possible trinity. So exchange rate regimes, you have fully dollarized countries. These are countries that by nature, they've abandoned their own currency and they've adopted an external currency, most times usually the dollar as their currency. You also have monetary unions whereby everybody agrees to use one currency, like the euro. Everybody agrees to use one currency and they jettison their own domestic currencies. You have a currency board, in which case what happens is that the currency in circulation, the currencies have a fixed exchange rate, and whatever currency they have in circulation is fully backed by dollar reserves, 100%. So, and the exchange rate is fixed. So in other words, they cannot increase money supply without increasing their dollar reserves. The dollar reserves are a function of trade and investment flows. So if they're doing a bit more trade, they're doing investment flows, the dollar reserves are increasing. Then because their exchange rate to the currency is stable or stable around a very narrow band, then their domestic currency in circulation is a function of that. So in reality, what tends to happen is that this occurs in places where prices are fully flexible across the economy. And there's very low share of non-tradable goods. The country has very small tradable goods. And of course, once you have this in condition, a country can pursue monetary unions, a currency board rather. One country that does this is Hong Kong. You also have a fixed parity condition, in which case countries just peg their currency at a fixed level to another exchange rate. You have the West African franc, the CFA franc across Africa, both the Central and the West African, the ZOF and the ZAF. Those are fixed exchange rate regimes. Their currency is fixed as a fixed exchange rate to the euro, which determines all other exchange rates. You also have different, and then people just sort of vary in between fixed and floating. So you have crawling pegs, which allow their currency move within a band progressively, and you also have the managed float, in which case there's countries that there's no explicit target, but they generally move their currency. They manage it sometimes, they fix it sometimes. Then you have the fully floating currencies, in which case market forces completely determine. There's nobody is trying to influence where the currencies are. Lastly, I think it's just to try and see the links between exchange rate and trade balances. For that, you need to remember this equation I have here in red, which is a fundamental identity you see in macroeconomics, which is that your net exports X minus M is a stable relationship, an identity between your net exports, your private savings, and your public savings. So note here is the sum of your net export position is always a function of two things: your private savings and your public savings. Private savings, aggregate savings over investment needs in the economy, and your public savings, which is the excess of tax revenues over government spending. So if that exists, then this fundamental. So typically they play around questions like they ask you, okay, if a country is running a deficit, it must mean that one of these relationships is in flux. Which is it? Is it that maybe savings are rising or savings are falling, or maybe a country is running a large deficit? So always remember this fundamental identity. How does exchange rate influence the balance of trade? There are two theories here. You have the elasticity approach and your absorption approach. So under elasticity, what it just says really is that is given by the Marshall-Lerner condition, which is given by this. But the key thing to just take away here is that if a country's exports and imports are fully elastic, in other words, if the elasticity of your imports and exports is very high, greater than 1, then if it's greater than 1, then of course changes in your exchange rates will help sort out imbalances in your trade balance or external account. So for example, a country is running a trade deficit. If their import and export elasticity is greater than 1, it's very elastic. What it means is that if they devalue their currencies, then they'll be able to get their trade balance back to normal, back to 0. And similar for a currency that's running a trade surplus, if they allow their currencies to appreciate, then of course their trade balance will get back to 0. So you just need to remember this identity. So sometimes they can play around, give you elasticity of certain items and tell you to work out whether a devaluation or depreciation will influence the trade deficit. However, it's not always instant because of what you have, the J-curve effect. So in other words, when you devalue, it's not immediately that. What you typically find is that your trade position gets worse before it starts to get better. So there'll be some of it is due to time lag, and then some short and long run elasticities in supply that will mean that things are not able to adjust fully. So you have that J-curve effect. Under the absorption approach, really, what they're just saying is that, again, they're just walking back to that identity, and they're saying that really, for a devaluation or depreciation to improve your trade balance, it must first of all increase national savings related to investment, in which case will then improve your ability to absorb, and then of course it will then lead to an improvement in the trade balance. I think what we'll just do here is just try and run through some questions here. Running. Just get a sense. Okay. Let me see. So you have you're giving here again, this one is just your cross rate essentially. Just trying to work out what your cross rate is here. I don't know if anybody can attempt the question. You're asked to find ZAR HKD. So you have these two currencies here, which give you what you're looking for. CNY. Yeah. We are looking for ZAR HKD. So the best thing to do is to invert this. So invert this. Invert this and multiply the product, multiply the result by that. So that gives you your answer. I don't know if anybody else. I think that should be. So invert this exchange rate and multiply it by the first one. That gives you exactly what you're looking for. So I think, yeah, somebody has the answer on that. So yeah. Okay. So yeah, so they then give the example here. Question 10, they say, so someone is quoting the ZAR SEK at 1.120. The arbitrage profit that can be earned is closest to. So to work this out, you need to work out what is the arbitrage condition implied by the Rand Swedish krona exchange rate. So this, you're just going to play with this and this. So in this case, you have the CNY ZAR and the Chinese yuan SK. So here you have to invert. Most likely you would invert this. You would invert the Chinese yuan ZAR, invert this again, and multiply your answer by the CNY SK. So if you do that, you multiply that. The difference between those two is what your arbitrage condition would be. So essentially we just 1/0.149 0.0218. So when we have that, we'll have a number. That number will be different from this number. And if we take the difference, multiply by 1 million, that'll give us what the trade looks like. Yeah. C. So yeah, someone has gone through C. Yeah. So yeah. So it's okay. So you say a BRL Mexican peso spot rate is quoted at this. The 6-month forward rate is this. The 6-month forward point is closest to. Again, we can work this out. It's just the difference between the spot and the forward. So the answer for 11 is just the difference between the spot and the forward. You scale it by the appropriate weights. So that would be. Anybody want to? So 0.1493 minus 0.1378. That should give us what we're looking for. 11A. Someone says it's A. Nah, thank you. Is it going to be a discount? Yeah, it can be A because you can see it's higher. So because it's higher, clearly it's not going to be a discount. It's going to be a premium. So yes, so the answer is B. Yeah. So sometimes the signs just help you. You can see the number is the forward is higher than, so it's a forward premium. So it's a forward premium. You can rule out A as being the answer. Yeah, so let's go to this one. This one says the 3-month forward exchange rate in CAD is listed by a dealer at 1.0123. The dealer also quotes the forward point as 6.8%. So this is forward point as a percentage of the. So again, let's remember. So when we have a forward, it quoted as a percentage, the formula is given by. For when it's quoted as a percentage is the spot rate times your forward rate is given by your spot rate times 1 plus your forward points quoted as a percentage. So in other words, the question is asking us to get what the spot rate is. So we are having to solve for this. That's what we're going to solve for essentially. So if we're solving for that, that means we're essentially going to have to take our forward rate divided by 1 plus our forward points in percentage. Our forward rate is already given here, so 1.023. So we divide it by our spot rate. That gives us our answer should be. Anybody show you that? A, okay, yeah. So A, yeah. So what they say here is if the base currency is in a forward is trading at a forward discount, which of the following statements is accurate? The base currency is trading at a forward discount. So what does that mean? Will the forward points be negative? The forward points be positive? And then C. So again, remember, I think this is just a reprisal of the question we had earlier. So it's trading at a discount, it means the forward point is most likely negative. Yes. So again, they say most accurate. Again, so because it's most accurate, potentially it could be this, but I mean, just leave it as B. A forward premium indicates A, B, or C. A forward premium indicates which of this, expected increase in demand for this American. It always has to do with an interest rate. You're always looking at what the interest rate will be. So it means the interest rate is higher in the price currency than the base currency. Yeah, so this is another question again that's similar to what we did earlier. So here they're giving you a spot exchange rate, JPY interest rate, and this, and they're asking you to calculate what the forward points would be. So here again, what we're just going to do is the first thing we'll do is work out what our forward rate is, which is given by our spot foreign domestic divided by 1 plus our foreign, scaled by 90 days over 360, and 1 plus our domestic interest rate scaled by 90 days over 360. We work that out. So our foreign currency here is the JPY. So JPY is our foreign currency, so it's our foreign interest rate here, and the AUD is our domestic interest rate. So always remember, the forward is always quoted, the forward premium is always quoted in foreign domestic. So always have that at the back of your mind. So if we know what our just insert 15% here, scale it by 90 over 360. Our domestic is 4.95, 90 over 360. Our spot rate is this. The number we obtain is the forward rate. We subtract it from what the spot rate is. That gives us our forward points. So anybody try that? Yeah, so someone has put up the answer as B. So yeah. And we can pretty much guess it's going to be a discount, right? Because the higher interest rate is the AUD. So if you're quoting it a currency AUD, that means the forward points will be a discount. So it's kind of trying to prove that the interest rate with the the exchange rate with the higher interest rate will trade at a forward discount. So, and if you look at the quotation here, it means so okay. Which of these is not an ideal condition of an ideal regime? We deal with convertibility, but we don't deal with this. So the answer is actually fixed. It actually says it's fixed, not floating. So I think we can. Yeah, I think we can. There are many things here. I think we can handle here the material. So I think we'll just call it a time with currency and move to other portions of the syllabus, the curriculum. So I'll just jump back in. Yeah. So what we then try to do now is run through demand and topics in demand and supply. The major thing under this material really is just to talk through elasticities, both price, income, and cross elasticities. Distinguish between and know how to calculate that. So that's really where the calculation, and the rest is just really trying to understand concepts really. So the first thing we'll just try and do is look at our demand function is given by quantity demanded as a function of several variables. The price elasticity of the good, which is own price elasticity, income elasticity, that's in other words, changes in income, how they influence your quantity demanded for that good, as well as price elasticity, cross price elasticity. So how do price changes in other goods impact the prices of the quantity demanded of a particular good? So typically it's given by these formulas, percentage change in quantity, where elasticity just basically looks to measure by how much does a percentage change in quantity demanded adjust with respect to changes in price. So, and then with elasticity, just how much does quantity demanded change with respect to income, changes in your income, and how much does quantity demanded product change in response to changes in elasticity. So essentially, what's to be given is the math around it, but the material is not trying to teach you to be. I mean, this is really economics, not quants. So really, what I always suggest is you're always going to first have to compute what the quantity demanded is. You figure out what the quantity demanded is. Work out take the coefficient of your percentage change variables, which is always typically given, and then your price is then your price, and then you work out what the price is at that level. And then typically that will help you enable you to compute what your elasticity is. So it's always good to walk through an example. So I'll just try and walk to pull up one. Okay. Okay, so here the question here says if the price elasticity. Okay, so this of the question of demand. Okay, sorry. Yeah. So let's look at this. Let's look at this question here. So this question here says the demand for membership at a local health club is given by the following equation. So you have quantity demanded for membership, 400, 5 times price. Now your quantity, so like remember I use QCP. So Q is your quantity demanded. So we first need to work out what our quantity demanded is. We know it's given by this equation. We have 400, we have 5. The missing element here is price. But it told us the price of health club membership is 35. So immediately this settles our quantity demanded. We can easily figure out what our quantity demanded is. So this number comes to 75. That's 225. So next thing we know is what's the coefficient of, so your elasticity measures your price elasticity, the coefficient of price elasticity, which is what we're looking for. We first of all get the equation, which is often given by the derivative with respect to that thing. So in other words, if we take a derivative of this equation here with respect to price here, the coefficient is minus 0.5. So that complicated thing in the formula essentially is this coefficient guy. So that's in here is 5. It's minus 5, well, it's minus 5. But for own price elasticity, we often take the absolute values. And the last thing we then work out is our price. So what's our price? Our price essentially is 35, which they're giving us. So from there we can work out using the formula what our formula is, what our quantity demanded is. Two to 5, okay. You can see a lot of people already at A already. Yes, A is correct. So yeah. So yes, so usually that's really for figuring out your price elasticity. Running through, yeah, I think I'll just stop and come back to my material. Okay. So the idea is really the same idea with the income elasticity as well. But it's always important to remember your interpretations, which I think I skipped. I'll just come back to now. So under interpretations, how do you interpret Okay, so how do you interpret elasticity? So for own price elasticity, you always take the absolute value. So in other words, if you get a minus, always ignore the minus signs and just take the absolute values. If it's zero, it's perfectly inelastic. In other words, no matter whatever you do to price, demand is not going to change. These goods are typically addictive goods. In other words, no matter what happens to price, demand remains unchanged. Um, Relatively inelastic goods, if you change price, it changes, but not by much. So it's typically it's less than zero. It's greater than zero, but less than one. Greater than zero, but less than one. If it's equals to one, unitary elastic, unit changes, in other words, equal changes in price translate to equal changes in quantity demanded. Of course, if it's relatively elastic, uh, a small change in price induces changes in quantity demanded. A perfectly elastic, typically these are, we'll see this later, I think, under monopoly, under perfect competition, goods that are traded under perfect competition. Small changes in price induce very large changes in quantity demanded. So if you change price a bit, quantity demanded changes by quite significantly. Income elasticity is typically either positive or negative. If it's positive, then it's a normal good. In other words, as your income increases, your demand also increases for that good because you're able to buy more of that good. If it's negative, it means it's inferior. If it's negative, it means it's inferior. So, in other words, your income rises, you just reduce your consumption of that good. Cross-price elasticity tries to look at consumption of a good related to another good. So if it's positive, in other words, if the price of, say, a particular of good one increases, demand for good two increases, then those goods are, if it's, then if oh, let me use the other way. If demand for a good increases, if the price of a good increases, the quantity of good one increases, the quantity demanded of good two rises. So in other words, I'm consuming good A and then suddenly the price rises, and then I stop consuming good A and I increase my consumption of B. Those goods typically are substitutes. So that's why the cross-price elasticity is positive. Negative, of course, means price increases for one good, and then suddenly what you see is there's an adjustment. So yeah, so I think what the material is just trying to just say is here is just look at goods that are goods that are just looking at how the income and price, trying to separate between normal and inferior goods. I think we'll just move on. Then another concept which we will see increasing is always the concept of marginal returns or diminishing marginal. I think people say almost everything in economics is diminishing marginal utility or returns, which says as more and more of a variable unit added to a fixed good, initially output increases, reaches a peak, and at some point begins to drop off. So in economics, we typically run through a product, revenue, and cost concept. So for productivity, the diminishing marginal returns just means that as more and more of a variable output is added to a fixed unit, output first of all increases, reaches a peak, and then starts to come down. You also have your revenue concepts, which is price. Total revenue is price times quantity. Average revenue is total revenue times quantity. Marginal revenue is change in total revenue, change in quantity. Under perfect competition, I think what's always important to remember is that because your demand curve is perfectly elastic, your marginal revenue is always equals to your price, is always equals to your average revenues. And so your slope coefficient is zero because it's just a horizontal line. It's perfect competition. Under imperfect competition, the slope competition is negative, but your marginal revenue is always slightly less than your price. Your cost concepts in economics, total cost typically made up of two things, variable and fixed. Your fixed costs are your costs that you can't do much change about, like rent on a factory, salaries of administrative workers. Whilst your variable costs are things that vary directly with each unit of output. Your fixed costs are typically a horizontal slope, which is because they are fixed, regardless of whatever output levels, you still pay these costs. And then your variable costs are, and typically that's where your total cost starts from. It starts from what your fixed cost is. And then your variable costs, however, start from zero, because if you're not producing anything, you're not incurring those things. So as you start to produce, you start to incur those costs. So they typically vary in line with each level. Then you also have your average variable cost, which is your average cost per unit of output. Typically, your average costs are typically U-shaped in economics. Again, just trying to capture the whole diminishing returns concept. In other words, if you keep increasing output, you get to a level where you're able to reduce. As output increases, your total cost will come down, because if you're producing more per unit, a lot, your fixed cost component is still bigger than your variable cost component. So as long as your fixed component are higher than your variable cost component, as you're producing more over time, because your fixed costs are fixed, over time your average cost comes down. It gets to a point, however, where they exceed the other, because your variable costs continue to rise and exceed your fixed cost, then your average cost starts to go back up. People call it economies of scale and things like that. When your average variable cost is falling, your marginal cost is below it. So typically your marginal cost is a U shape that cuts your average cost at the point of your lowest average cost. And we'll say that point is always where companies should always produce that, because that's the point where their cost curves are at the lowest point. This syllabus also wants you to know when is a break-even point for a company. The break-even point, the shutdown point of break-even. Break-even is typically given by when you're under perfect competition, your price equals your marginal revenues equals your average revenue, which is also always equals to your average cost as well. So that's your break-even. Okay, so maybe I'll just use this slide to talk through. Yeah. So when should a company shut down, and when should they sort of remain in the market? What this is just trying to say is that a company can be making losses, but there are periods when beyond those points, there are losses when if you continue to exceed, your losses exceed a particular number. What's that number? Typically is your variable cost. In other words, if you're a company, your average revenue can exceed your average total cost, you continue working. But if your average total cost exceeds your average variable cost and is greater than your average variable cost, so in other words, your average cost is greater than average revenues, your average revenues are less than your average cost, it doesn't matter, you can continue in the short run to remain in business, provided your average revenues exceed your average variable cost. So as long as they exceed the average variable cost, you can continue. In the long run, however, you may need to consider other things to do. But if your average revenues do not cover your average cost, then it's advisable you just shut down and exit the industry. So same concept applies to total. If you're using the total cost approach, as long as your total revenues can cover your total cost and your total variable cost, you can continue the market. Once it exceeds it, typically it's advised you just shut down and then we move on. Break-even points, I think in economics always to remember, is it always cuts you, and where your marginal cost is always where your marginal cost on that cuts your average cost. That's where typically companies would like to produce. That's always typically where it's also their break-even. Concepts around economies of scale, increasing long run. Just take some questions here. Some questions to walk through here. Okay. I think we'll just run through questions now. Okay. So number 3 here says price elasticity for a good is likely will most likely be greater if there are no substitutes for that good. Price elasticity, I guess we can just answer this question. So where we have issues, we just draw to that. Price elasticity of demand for a good will most likely be greater if there are no substitutes, or B, people consider the good as discretionary, or C, consumers spend a small portion of their budget on the good. Which is it? I think the answer is B. Yeah. So the answer is B, because if you consider a good as not be discretionary, in other words, it's not something that is major in your budget, and then the price suddenly changes, just free it. You get it. It's not too significant. If there are no substitutes for a good, price elasticity can be great because you don't have a choice. You just continue consuming it. So it's more likely going to be elastic. And if it's a small portion of your budget, you may be indifferent towards it. So because it's very tiny. So even if the price rises, elasticity may be inelastic. But if it's discretionary, something you consider not necessary, you may likely just adjust your expenditures to it. If income elasticity of demand for a product is -6, what does this mean? Remember we talked through this. Number 4. Will a 1% rise in income result in a 0.6% decrease in demand? I think yes, that's more likely what the answer looks like. Yeah. So they're giving us here one of the examples, I think, just to play around our understanding of elasticity concepts, really, which is you're given a price of onions, PO, price of income level, as well as price of tomatoes, and then given this the quantity demand for onions. And so the question wants us to compute, you're given the price of onions, given the price of tomatoes, and given the household income level, and it says what's the cross price elasticity of demand for onions with respect to tomatoes. So in other words, we're trying to compute the cross price elasticity. So the first thing, as always, we do is we try and work out what our quantity demanded for onions is. We just insert these numbers in here and work out what our quantity demanded is. And the coefficient we're interested in is the coefficient in respect to tomatoes, which is this. And we know what the price of tomatoes is as well. So we work out from there. So someone plug in these numbers, and what was the answer? Some sharp guys already. So first thing we just do is we plug in 1.25 here, plug in the household here, and then plug in the price here. Obtain our quantity demanded, which is the first step. And then we know our coefficient of tomatoes is -0.16. And then lastly, we work out what the price, we know the price of tomatoes already is. And then from there, we'll get our answer if we try that out. So, let's see. Okay, any takers? Let's see. .05 times 1.25. 0.0625 plus 1 times 2,500. Any takers? Anyone solved it? Okay, looks like people are struggling. Okay. Yeah, so the first step I was trying to describe is this. So you plug in 1.25 here, 2,500 here, and 3.75 here. So that gives us our quantity demanded as 24.8375 for onions. From there, we just play around with the formula. So we know our coefficient is given by this, coefficient of demand with respect to to price is 0.16, and we multiply it by price. Price is given by, of tomatoes is given by 3.75. Quantity demanded, which we just worked out, is this, and we arrive at this. I think let me work it out. So whenever we have to work out, as I said, you always, the three things you're trying to compute is QCP. Always remember that. Your quantity demanded is the first thing you compute, which is you just plug in the numbers you're given into your quantity demanded equation. Then you obtain your coefficient. Your coefficient is given by, with respect to the elasticity concept you're trying to, because we're trying to get cross-price elasticity, that's this coefficient. And our price of tomatoes is given to us is 3.75. So if we apply the elasticity formula, is always going to be something like this, minus the derivative with respect to demand, derivative with respect to xy, times price over quantity demand. So if we have that, we know what C is. C is 0.16. We know what the price is, 3.75. We know what the quantity demanded is. That's what we just worked out. That's how we get this number. I don't know if that's fine for everybody. Movement along the demand curve for good occurs due to a change in its most likely price. Yeah, 6p price. A wireless phone manufacturer introduced a next generation phone that received high level of publicity due to several high-speed production lines. So the following is the most plausible explanation for the demand supply imbalance. 7 price. We just introduced similar price and yeah. I think the answer is A. Okay, yeah. Okay, let's try this one this time around. So let's get our hands dirty with this one so that at least everybody, because this is a comprehensive question, it takes all three into consideration. So we're given the market demand for private universities given by this equation here. So it wants us, first we're going to compute the price elasticity of demand for private universities. So what's the price elasticity of demand for private universities? Assuming everything else is constant. So to do that, again, remember our QCP concept, we first need to compute quantity demanded for private universities. Quantity demanded for private universities. So to compute quantity demanded for private universities, we know the price of private universities is, as this is given by, what is it, 38. So essentially, this is what we're going to first of all solve. Quantity demanded for private universities, 84 minus 3.1, 38 plus 0.8, income level is 100, and then plus 0.9, price of public universities, which is 18. So what does this give us? Does anybody shut it down? What does this give us? $62.4, yeah. So now that was the quantity demanded, 62.4. So from here now, we're going to compute for private universities, price elasticity for private universities. So that's given by, the formula will be given by PED is equals to the coefficient, which is the delta of quantity demand times price of private universities over quantity demanded of private universities. So the coefficient we're looking for is the price elasticity of demand for private universities. So this coefficient here, which is the coefficient I was always talking about, is given by this guy. because that's the quotient of price with respect to private universities. So we have minus 3.1 times our price for private universities told already is 38 divided by our quantity demanded, which we just worked out. So what's our answer? Your answer is already going to be B. So someone has worked it out. That's going to give us 1 point. So is this which elasticity is this? Is it income elastic? Which is it? Is it inelastic? What is it? What is this guy? Is it inelastic? Is it elastic? What is it? As always, with price elasticity, own price elasticity, we always take absolute value. So it's elastic, very good, it's elastic. Now, we want to compute it with respect to income elasticity. Now, we want to compute question 9. So question 9, again, because we already solved this equation, what we're just going to do is just modify this. So price elasticity for income is going to be given by percentage change of quantity demanded respect to percentage change in income times your income over your quantity demanded. So what we are just going to do here essentially is just so we know the quotient of income is 0.8 times your income of 100 over your quantity demanded, which we just got is 2.4. Multiplied, we get what? Someone has already worked it out. That's C. Yeah, so it's 0.8. Okay. Okay. Any more takers? Any more takers? So yeah. So lastly, cross price elasticity. For cross price elasticity, you just been around the same thing again. You just take the coefficient for cross price, which is this 0.9. That's the guy multiplied by what was it? Cross price, which is 18. Price of the cross product, which is 18. The quantity demanded is 2.4 multiplied. So we should get number 10. We should get 8. Yeah. So we should get 8. So yeah. So if the cross price elasticity for two goods is negative, the goods are described as what? I mean, this is just easy from the syllabus, from the material. This should be easy. Yeah. This should be C. So yeah. So they're both complements, exactly. So okay. Let's try and run through. I think for the rest we can. Let's just go to this guy. Yeah. So number 16. Number 16, what we just need to do is, again, for this concept, you just need to just figure out what your marginal product is really. MP. So your MP table here will look something like this. First one, nothing. Second one would be 5. Third one would be 6. Fourth one would be 5. And the last one would be 2. So based on the question, where does number 16, where does it come from? After which machine level does marginal returns, diminishing marginal returns? Diminishing marginal returns says that, what it just says is that at a point, it just looks at what level will your marginal product begin to decline. Your marginal product is given by the change in your total product, which is from 3 to 8, which is 5. From 8 to 14, which is 6, from 19, which is 5. So where did marginal product start declining after? It's clearly, it started declining from here when it came down to 6, which is after the third machine hour. So your answer definitely here is A. So yeah, move on. So yeah, so in case they give you table, that's how we sort of run through it. Yeah, so yeah, they say the market director of a specialty estimates the firm can sell this at 500,000 total revenues. However, if 250 units are sold, the revenue will be this. The marginal revenue associated with 250 units instead of 200 units is what? So again, here what you're just going to gain is you're just looking at your number of units, your change in your total revenue by producing 50 units from the original one. So basically, we're just looking at the change. So the change here is 100,000 Swiss franc, 100K Swiss franc. The change in units is 50. So we get our 2K. Yeah, so the answer is A. So, agricultural firm operating in a perfectly competitive environment. The firm would like to expand or create supplies wheat. If the firm would like to expand production and unit sales by 10%, the most likely result would be, so in other words, you are operating in a perfectly competitive environment. Now, in a perfectly competitive environment, prices are fixed by the market. So the firm is a price taker. So if the firm wants to increase production and sales by 10%, so if it increases production by 10% and increases also its sales by 10%, its total revenues would rise by what? Because total revenues is given by price times quantity, and price is fixed in this case. The only thing they're telling that they're increasing is unit sales. So if unit sales increase, if production increases by 10 and they're able to sell everything they've done, then it must be that total revenues will rise by 8. Because total revenue is given by price and quantity, and because they are operating in a perfectly competitive market where everything is the same. The price is given by, so nothing changes in your price. The only thing that really changes is your output. So if your sales is rising by 10%, your production is up by 10%, the total revenue must rise by 10%. Yeah. Operator in its key resort is considering price reductions on a weekday basis. Nominal price is 50, 300 customers. A discounted price of these special bus passes. Marginal revenue from offering the discounted price is closest to, okay, normal day price of 50 per day, 300 customers buy passes. Now he discounted the price to 40 euros per day. 450 customers buy passes. So what's the marginal revenue from him reducing his prices? So we just compute what was our marginal revenue in the first instance, our total revenue in the first instance, which is marginal revenue per unit of customer. 150. Oh yeah, somebody's already quickly figured it out. So yeah, it's 28. Okay, I think let's do some cost calculations as well, so we get comfortable with this. Yeah, total fixed cost, total variable cost. When the quantity produced is equal to 4 units, the average fixed cost is closest to when the quantity produced equals to 4 units. In other words, you're here. What's the average fixed cost? So that's just basically your total fixed cost divided by your quantity. So 200 over 4, which is 50. So the answer is A. When firm increases production from 4 to 5, the marginal cost. So to arrive at that, we need to add these two columns together. So from 4, that means total cost is here is 440, and total cost here goes to 520. So when they increase output from 4 to 5 units, the marginal cost as the increase between these two is you see, it's 80. So the difference between those two is 80. Yeah. So that's P1. Refer to the data in Exhibit 1, the level of unit production resulting in the lowest average total cost. So which unit gives them the lowest average total cost? So we just need to figure out what our average total cost is essentially. So divided by the units. I think that number is divided by units. So divide 500 by 5, 440, and this is 110. 400 by 3 is definitely 520 by 5 is 104. So this looks like the lowest because you have 3, 4. This is 133. So clearly the answer is 5. See, so it's 105. Okay, I think yeah, we'll just try and run along now to some other things. I think pretty much okay here. Okay, back here, let's do some macroeconomics. I think I would just briefly like to run through is the concept of markets here. So markets. So yeah, you have different market types, perfect competition. I think it's just good to sort of try and know. What you have here is in reading 13 is largely descriptive. So really it just asks you to just understand relationships, not ask then how to calculate things. You can come survival, just understand concepts essentially. I think this one, what I just wanted to just show was just if you're given a Nash equilibrium, sometimes you see this come out as well. Nash equilibrium. How do you work out where the Nash equilibrium is? So I'll just run through a simple trick I learned of how you sort of always do. So Nash equilibrium basically operates under an oligopoly. Oligopoly is a system whereby you have few sellers creating roughly identical product or standardized products. Barriers to entry are very high, so not many players typically operate there, and each firm has considerable, some to an extent, pricing power. And then, so under oligopoly, you have different means of competition. You have the Nash equilibrium, you have common solution, you have king demand. Nash equilibrium is one of them. Under a Nash equilibrium, what it says is that you don't have any equilibrium where any player can unilaterally change their pricing strategy to improve their fortunes in the market. Every firm seeks to maximize profits. It's a non-cooperative, so firms don't collude or cooperate, but they depend on each other. In other words, they depend on what each other. If one person does something, it impacts the other person one way or the other, but not as if they are cooperating. Each firm tries to anticipate what the other firm is doing and react best based on that. That's how these three assumptions are very strong to arrive at a Nash equilibrium. So in other words, my goal is to maximize profit. Dependent on what the other person is doing, because that impacts me, but I don't cooperate with him. But at the same time, I try to anticipate what he's doing. So we're giving an example here where you have two firms. They have two strategies in place, essentially. One strategy essentially is to pursue a low price strategy. Another strategy is to pursue a high price strategy. So I'll just use ARCO, BADCO. So in other words, they're either pursuing a low price strategy or they're pursuing a high price strategy. You're either low price or high price. These are the two strategies available for each firm. Now, if ARCO plays low price and the other guy is playing high price, the outcome, I always write whatever ARCO is doing as first and whatever the other guy is doing as second. It's 50-70. So you know what, this is the state of play when they're both pursuing low price strategies. If ARCO is playing high price and the other guy is playing low price, that means this is the outcome you see. 300, the other guy is producing low price, 350. If on the other hand is Baku, is this scenario whereby Baku is playing high price and Akko is playing low price. In other words, what you have here is that Akko will earn 80, while Baku will earn 0. And then of course, if it's the last state of play whereby both are playing high price ranges, Akko earns 500, Baku earns 300. So now the number in front belongs to Akko, the number behind afterwards belongs to Baku. Now each firm always seeks to maximize profits, and they also anticipate what the other person is doing. So for Akko now, he has two strategies, high price or low price. Now, if he assumes that the state of play, Baku is playing a low price strategy, in other words, Baku is in this state of play, he ignores this one for now, he just ignores it. So under this strategy, if Baku is playing low price, the best strategy for Baku to follow is definitely, he earns 500 if he plays a low price strategy, while his opponent is playing a low price. He also earns 300 if he's playing. So what he does, he's maximizing profit, so he'll definitely play this game, he'll play a high price. Because if he's playing a high price and his opponent is playing a low price, he's definitely going to earn 300 on that strategy. So that's what he'll go for. Now, if he feels his opponent is playing high price strategy, in other words, his opponent is not playing low price, high price, which outcome favors him? Because he's maximizing profit, he'll play this type of play. He will ignore, he will play a high price. So he will always play a high price, whatever the outcome. Same thing for our Baku. He has two strategies, high price or low price. He doesn't know which state of play Akko is in, but he assumes, okay, if it's in a low price, the strategy available for him is to play what? Is to play low price. Because if he plays low price, he gets something. If he plays a high price strategy, and this other guy is playing low price, he gets 0. So he plays low price. Now, assuming his opponent is playing a high price, which strategy is optimal for him here? Low price or high price? It's optimal for him to play what? Because he earns 350 here if he plays a low price. If he plays a high price, he earns 300, which is lower. Because the profit maximizing, he earns it, he plays here. So the natural equilibrium for this outcome is that Akko plays a high price and Baku plays a low price. Somehow always ends up that way. So just always sort of try and walk through each firm strategies, just set out in each and assume that the other person's outcome is given. So just assume that he's playing this place, and then you try and walk through to figure out he's trying to maximize profit, which state of play works best for him. Always sort of try and figure it out. I think there's an example in the curriculum as well. So we'll just try and figure it out. Okay, yeah. So we have this example here whereby you have two firms here, both playing open and proprietary strategies. So again, if you just try and work it out, so you have Sigma Soft. They can either play an open strategy or they can play a prop strategy. Then you have Theta, who can also either play an open strategy or prop strategy. If we're in the first state of play where they're both playing open, the first guy, Sigma, gets 400, the other guy gets 600. If they're in this state of play where Sigma is playing prop, the other guy is playing open, he gets 650, the other guy gets 700. If they're in this state of play where Sigma is playing open, Theta is playing prop, 800, 300, 600, 400. Yeah. So again, we just run through each game in bits and pieces. So Sigma typically would assume the other guy, take it for granted what the other person is doing. I assume this guy is playing open. Which strategy pays me if I know it's in this state of play? Do I play open or do I play prop? It's better for me to play prop because I get 650 higher than 400. So I play prop. Now, if I'm in the prop state of play, and which strategy best for me, open or prop? It's better I play open because I get 800 relative to 600. Same thing for Theta. Theta is playing either open or prop. If he's in this state of play, what's best for him is to play 600 because if you play 600, he gets more than the 300 if he plays prop. And then if it's in this state of play, in a prop state of play, he gets 600, 700 as against 400. So the Nash equilibrium here would be what? Would be that sigma plays prop, theta plays open. I think the answer should be C, right? Yeah, the answer is C. So yeah, so I mean that's how to just sort of walk through Nash equilibrium type questions. What I'll just do now is try and run through very quickly what we have for the macro slides. Yeah. So GDP, I mean, GDP questions typically, they just try and check your test you understand. So you look at the curriculum, it wants you to understand how to compute GDP based on expenditure and income approaches. And then it raises a lot of concepts, a lot of conceptual things, but you only just need to understand how to calculate GDP. GDP, the different ways of computing, you have nominal and real. You should be able to distinguish between those two. Nominal is current, real is adjusted for inflation. Your real GDP can also be your nominal GDP divided by your GDP deflator as well. Your GDP deflator formula you should also know. And then per capita GDP is just whatever GDP concept divided by population. It's a proxy for standard of living. GDP measures final goods and services, market price of finance over a specific period. A difference to nominal GDP between GNP and GDP is that GDP is domestic within the borders of a country. GNP is by citizens of a country wherever they are. It's more practical to produce GDP. GNP is a bit tricky because people are in different places and you don't really have much data on that. Yeah, so under the expenditure approach, C plus I plus G plus X minus M, consumption is your household spending, investment, government spending, X minus M. You also have the value added approach, in which case you just back up. And so what they just do under the value added is a baker who is making bread. He's a final producer, but there were other inputs he took along the way. So rather than sum up, you just add the value added by each person in each stage of production. So yes, at each stage, the baker, let's say the receipt, the bread costs €1 here, the example here, but received by each person. The farmer sold it for 15 cents. The miller 46, the baker to the retailers on it, and the retailers to the customer one. So what you just do is you don't sum up everything here and say, well, the sum is the sum of 15 plus 46 plus 30 plus 1. You take the difference between each stage. That's the value added, and that is your GDP sum. Yeah, so how do you compute gross domestic income? It's net domestic income adjusted for depreciation, also called capital consumption allowance or consumption of fixed capital. That's different between GDP and that's gross domestic income and net domestic income. You're just adjusting for the fact that some components are depreciation and there's statistical discrepancies. And then you should know how to walk through personal income. I think a lot of this is just remembering the formulas. In terms of the concepts, aggregate demand basically just combines your price and aggregate income levels. Your IS curve basically tries to solve for income level. It assumes interest rate as given. It doesn't say whether it's appropriate or doesn't make any comments about inflation or interest rates. It just tries to work out what quantities of output are consistent or income are consistent for a level of interest rate. So it's given by solving for your aggregate demand function, which is C plus I plus G plus X minus M. This identity is one that you would always see in a lot of areas in economics model. So you sort of always have to have it in mind. Yeah, so most times they play around questions by rearranging this identity. So you should always remember this identity here. It's like, I think it's like the key identity. If you can always remember this identity, you can always figure out what concept they're asking you for, whether it's fiscal balances or net exports or savings. If you can always remember this, questions always typically play around this. Oh, a country is running a fiscal deficit. What does it mean? Does it mean that savings is, so you should typically just rearrange the function and try and figure it out. I mean, typically you'd always just rearrange it and try and figure out what the identity is, what the question is asking for. So for example, a company is running fiscal deficit. It must be that their aggregate savings is less than their net exports. That's why this number is that's why expenditure is higher, because it means that aggregate savings, the aggregate savings number is not enough to cope with that. So you should sometimes be able to sort of work around these identities. The what drives changes there, typically consumption is the biggest driver of there. Your LM core basically just tries to adjust for interest rates and price level. So it incorporates interest rates and price level, and it's given by the quantity of money, price times output. Nominal GDP is given by velocity of money and nominal and money supply. So typically is how they resolve the equilibrium in the money market is your quantity of money, MVPQ. Running fast out of time. Shifting AD curve. So what factors tend to drive that? I mean, I think you can get this material and look through them. We'll share the slides so you can sort of see what these concepts are. Most of it are about the conceptual. So what else? Oh yeah. So typically, what things they typically always ask: what concepts around sustainable growth? Potential GDP typically is always growth rate is typically driven by what tends to drive growth rate over the long term. Or sustainable is the growth rate in labor force and the labor productivity growth rate. So how big is your labor force growing? How productive are they? These factors are sort of seen as intrinsic over the long run. We have different theories. Neoclassical model, typically at the heart of it all, it says that long-term growth is driven by what they typically find is by total factor productivity. Differences typically between countries is driven by your technology. So technology is always a big driver of what you see. So yeah. So I'm sorry, I'm running out of time. Yeah. I think business cycle phases really here. Really, what we just have here really is really just going through the business cycle, really. So which is just every country has 4 cycles: peak, through, growth. Just trying to identify what I say is symptoms or features across each stage. So when a country is in recovery, what happens to key variables? You should sort of be able to remember those. I think they typically always bring out questions. If you see this, you see this, you see that. Which stage is the economy in? So try and always sort of remember that. And then theories of business cycle, classicals, Keynesians. All of it is theoretical. I think most of the tricky part you face in the economics model typically will be currencies, playing around GDP, and then you have your elasticity questions that typically come every now and then. So yeah, I think what we'll just do is we'll share the slides, and I wish you all the best. If you have any questions, you can. I think the society office will share the slides. So, all right, then I think I'm done. I don't know if there are any questions. If there are any concepts, I think. So yeah. All right, thank you all. I think I'll just hand over. Yeah. All right. Thank you. Bye-bye.
Thank you, Wale. So it's 1:30. We're going to go for a 1-hour break until 2:30. And at 2:30, we're going to have Musa Bagudu and fixed income. So you guys enjoy your break. We'll be back at 2:30.
Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Are you thinking of a CFA prep provider where you can get high quality tuition that will be delivered by some of the very best investment and finance professionals? Think no further, Ivy League is the place for you. At Ivy League, we have a consistent history of delivering and surpassing on our students' expectations across several finance qualifications. At Ivy League, our tutors share a unique characteristic of being very skillful, very passionate, committed, and above all are dedicated to the success of our students. Our CFA lectures holds weekends from 9 a.m. to 6 p.m. on Saturdays and 11 a.m. to 6 p.m. on Sundays. Each class will run for 2 hours with a 15 minutes break in between classes. The classes will be delivered via our virtual learning management system. Why not join us at Ivy League? Simply visit our website on www.ivyleaguenigeria.com/CFA.